going to slow over the course of the next 12 months. The question is what happens after that, and we're back into a more normal trajectory, assuming these supply-side disruptions dissipate.
Right. Michael, the media is on the y-axis. You're down below looking at the time function. What is your x-axis of where bonds move forward? Are you looking at weeks and quarters, or are you really taking a focus out 1 and 2 years?
I think it's quarters. In a longer term, there's no doubt that the pricing of interest rates, both nominal and real, are very low indefinitely into the future, multi-years into the future. And if real interest rates are going to be negative indefinitely into 2024 or 2025, even the Fed's projections out to 2024 are suggesting that we're going to have negative short-term real interest rates, is fairly pessimistic about growth potential for the U.S. and global economy. And we'll have to see if that's true. I think it's too pessimistic, but right now it does look like yields are going to be capped in the short run. We've seen that with the flattening of yield curves on the back that, yes, inflationary pressures are pushing central banks to act sooner, but the cumulative amount of rate increases are not increasing. The terminal rate, the final rate we're getting to, is not really changing very much at all, suggesting that long-term interest rates are capped.
Michael, we got the Bank of America Fund Manager Survey overnight, and they showed that bond allocations are at a record low. Isn't this bullish for bonds?
I think so. Everyone is worried about tapering from the Fed. But on the other hand, the U.S. fiscal deficit should shrink dramatically next year, such that the net supply to the market, net of Treasury issuance, Fed buying, should be pretty balanced, if not be negative. I don't see a supply side issue on treasuries right now, and global demand for risk-free assets is still strong. I mean, the treasuries are the world's risk-free asset. Is something which everyone in the world, well, not everyone, but is used as a store of liquidity in the world, and that's not going away. So I think that the level of U.S. yields today relative to the rest of the world is also very high, meaning the U.S. is a high-yielding alternative, and the dollar still looks, for now, fairly firm.
Lisa, just repeat that stat. I think that's so interesting. Repeat that stat again.
Okay, that global bond allocations have reached a record low, this according to the Bank of America monthly fund manager survey, which is shocking and goes to your point of the fact that people are bearish when you ask them how they feel, but they are bullish in their allocations, with stock allocations continuing to go up.
Just thinking a little bit more about that, though, Lisa. This is the most bearish fund manager survey we've had since last year. Your allocation to bonds is falling and not going up, and allocation to equities is higher. And Michael, that makes me wonder if the risk is inflation here, whether I get the protection from the bond market. If I get less constructive here, whether equities is actually providing me with the protection I won't get from the bond market. Michael, how do you think about that?
I think that's a good question. We've seen twice this year. We've had this massive inflationary shock towards the end in recent months on the view that supply side chain disruptions are not going away. Inflation is going to be higher for longer. Central banks may react to it, and the 10-year Treasury, still struggles to get over 1.6%. Back in the spring, when we had maximum bullishness about everything in terms of growth dynamics, fiscal expansion, central bank easing or low rates forever, we got to 175. That was it. So we haven't seen much pessimism about the trajectory of interest rates going forward, that given past experiences, whether it's 2018, previous rate hikes post-2000, the global financial crisis, the Fed and central banks around the world have struggled to get interest rates much higher than they are where they are today. So I think people are pretty comfortable with interest rates are going to be pretty stable. It's not that people are necessarily so bearish on bonds. It's just that where is the return from bonds? You're looking at negative returns from many sectors of the bond market. That if you want to make money, you need to find something else to do, whether it's the riskier end of fixed income or it's equities or something else.
Michael,
along the way with private investment.
Before we let you go, as John was saying, we have a ton of Fed speak today. Harker, Barkin, Bostic, Bowman, Waller, all of these people are coming out and discussing their view ahead. How much are they going to push back against rate hike expectations that a lot of people believe have gotten ahead of the Federal Reserve themselves?
I think that the dovish end of the board and the FOMC will start pushing back against the pricing that the market is having, which is now outpacing the Fed rate hikes through 2022, 2023. We're talking about 100 basis points plus into middle of 2023, which was not true just a couple of weeks ago, it seems. But this is a global phenomenon. So the question is whether they push back or not. Given the pressure coming from outside the United States and how hawkish some of these central banks are, whether New Zealand's a small country, but they're become very hawkish. The UK is in central bank seems to be insistent that they're going to be raising rates sooner rather than later, meaning this year, that there's a global thing going on that markets are not comfortable with the idea that central banks are going to be dovish. So they may push back, but I'm not sure how much the market's going to believe them.
Michael, thank you, sir. Got to leave it there. Michael Cushman there of Morgan Stanley. Just summing it up brilliantly, Tom. It's plain and simple. The market believes the Fed will tighten more than the Fed thinks. That's the bottom line at the moment.
Yeah, it is the bottom line at the moment. And also, John, I look at the equity market reaction today. I mean, you know, his rationality there is appropriate. Look how the market's rationalized, John. Standard & Poor's 500 futures, 4,500.
Up another 0.5% on the S&P. Subhadra Rajappa of SocGen joining us on this bond market in the next hour. Don't miss that. From New York City, this is Bloomberg.
When I had a look, it looked like she was blind. The vet that she's registered with were only doing telephone appointments, which was a bit pointless because she really needed to be seen by someone. And I couldn't get one anyway for like another week. I was just quite worried about, you know, the complications of leaving it for so long.
We've seen millions more animals becoming pets in the past year due to the people having increased time at home. What we're also finding is due to Brexit that we're having decreased numbers of European vets working over here. So unfortunately, we're unable to meet that current demand for pet services. Also, COVID's got the inevitable impact with people having to self-isolate.
It is very limited what we can diagnose, so it's more about peace of mind and determining whether they do need to be seen in person.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
You're looking at the Fed, probably is on hold next year still. I think maybe you get one hike, but I don't see 2 hikes next year at all.
Central banks have very little latitude and flexibility to say, no, we really cannot hike.
Central banks aren't very good at being nimble when they're trying to catch up from being behind the curve.
At the end of the day, the balance sheets are fine. The consumers are in great shape. The appetite is very, very healthy.
If we slow to 3% next year, we're still growing well above potential.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Spare a thought for an equity market bear from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow, up 22, up another 0.5% on the S&P. Tom, it's a 4-day winning streak within 1% from all-time highs.
You go up, you go down. It's the way you do it, John. And the way we do it this way is an impulse. Must watch, must listen here in minutes. Gina Martin Adams will discuss and link this, John, into earnings like Netflix, I believe, this afternoon.
We've had that big churn beneath the surface, Tom. Beneath the surface, a lot going on, tons of chop. At the index level, is it fair to say this is one heck of a resilient equity market, Tom?
The gloom crew's been crushed here. They got to redo. I love what Doug Cass says, and he talks there about what we've heard through this morning about sluggish growth and inflation, and how maybe you can endure from that. This idea of slugflation, not stagflation. And John, it's just a stew here where what do? You buy the dip. That's what we've seen.
We start this morning, Lisa, staring down all-time highs on the S&P 500 and somehow talking about the least bullish fund manager survey from Bank of America in more than a year.
Yeah.
Make sense of that.
The irony is that the more pessimistic people get on growth, perhaps the better for this Goldilocks scenario. If you tamp down inflation expectations over the longer term, it puts a cap on bond yields, as Michael Cushman was saying, and then people have nowhere else to go. To your point, John, stocks suddenly become protection rather than bonds, which is an ironic turn of events.
Earnings season so far, so good. So far, so good. Still tons to come. Here's your equity market this Tuesday morning. We're up 22 on the S&P, advancing 0.5%. There's another lift in this equity market on the Russell, on the Nasdaq. The Nasdaq up 0.4%. Yields in on the bond market to 159.32. And Tom, I don't think this is lost on anyone. We're doing this with expectations of higher interest rates of the Fed, never mind tapering. We're doing this with a serious conversation about hiking at some point next year.
Maybe that's a shoe to drop, and that certitude of higher rates or the path to higher rates drifts away. I don't know. What I would suggest, John, is we're doing this market lift with commodities signaling global demand.
Brent at 85, Lisa, WTI
to me, that's more interesting,
50,
frankly.
and up by more than 1%.
And I will say, John, to your point, though, the fact that the market is still rallying, even with 2 rate hikes baked into next year, shows the resilience, and frankly is ironic to me that Fed officials would push back, considering the fact that perhaps they want to embrace this if the market is basically giving them a green light. 8:30 a.m. you get U.S. September housing starts and building permits. The expectation is for it to stay high, although come off a little bit. The idea here is we're going to be talking about supply chain disruptions, the idea that labor is in short supply. Take a look at Zillow, crashing more than 11% yesterday after saying that they were going to stop buying homes and flipping them. They just don't have the people available to do the renovations and to get it out on the market. There also may be some other issues there. Today, Milken Institute is having its second day of global conferences. And to me, I think it'll be interesting to hear, particularly what Kathy Wood of ARK Investments has to say, but also Howard Marks, the legendary investor from Oaktree, and Stephen Mnuchin, former U.S. Treasury Secretary. And Tom, as you were talking about, after the market, we get Netflix's third quarter earnings. The expectation is for it to be great. It better be, since the shares have basically gone up 100% year to date, plus or minus. And basically, people are going to be looking at what is next after we just saw their blockbuster that has gotten all of our children very interested. And
not good that it's all our children, is it? I mean, all our children are watching that.
There are
I'm
a lot
uncomfortable
of good,
watching that.
Have you watched it?
I will not watch any of that.
No. There actually are some pretty deep social messages.
They're watching surveillance,
They're watching
Tom,
surveillance.
aren't they? Should we do that shout out now?
Let's do this shout out. This is lovely, folks. This is what it's about. This is why we do this. John, bring in the child, the offspring.
Here's the tweet. Got to start them off young, or they'll never have an interest in equities and bonds. Also won't know how to provide proper condolences to a tot supporter. Thank you, sir. This is the 4-way right on Twitter. Congratulations for your first child, son.
for maternity advice, John, why don't you bring in our next guest?
Maybe
I have no idea what I'm doing.
Maybe don't come to me or Tom on any of this. And Tom's had practice.
Yes, I've had practice.
Gina joins us now.
Don't
Gina
drop the
Martin,
baby.
Chief Equity Strategist at Bloomberg Intelligence. Gina, I want to start with the equity market backdrop and the inflation story. Piece of research from you and the team. The inflation story is still too weak to stop stocks. Gina, what do you mean by that?
Yeah, I think when we think about the balance of growth prospects as well as inflation pressures, growth is still winning out. I mean, we see this for sure in the earnings stream where earnings are still growing at a faster pace even than revenue growth. So as much as there is inflation pressure, certainly stickier than expected inflation, higher than expected inflation pressure, the reality is that demand is still accelerating rapidly too. I don't see this slowdown in growth that many people are worried about really manifesting itself. We see when we look into 2022, just as a perfect example, next 12-month earnings growth for virtually every economy around the world is going to be faster than 5-year average. That's still a slowdown, certainly from 2021, but really rapid earnings growth is a big story that I think is driving global stocks, even amid inflation pressures, which are certainly eating away at margins. And the result is bottom line earnings growth that is still much faster than many people have anticipated and continue to sort of underestimate.
Well, Gina, to that point, we got Danone, John was talking about this earlier, coming out and saying that they're going to have to pass along some of the increases that they're seeing in the price of milk and transportation costs. How much have margin pressures been already baked in, considering the fact that we've been talking about this for a long time?
Yeah, so really in consensus estimates, margin pressure started to fall in fits and starts in May and started to accelerate to the downside in September. But still roughly half of S&P 500 companies are not showing any downdraft in margin estimates at all. And the half that are showing a downdraft in margin estimates are experiencing that for third quarter and fourth quarter only, not all the way into 2022. I do still think there is some degree of risk with respect to S&P 500 companies that analysts are still not fully capitulating to the inflation trend. There certainly is still some risk even to top line considering how fast oil prices have gone as well. So we've got at least another quarter before we can really clear a lot of the risks with respect to margins. But I think it's healthy now that many people are talking about the supply chain constraints lasting for a lot longer. We're even hearing things like supply chain constraints are going to be around for 24 months. That kind of language and constant guidance from companies will ultimately land analyst estimates in a solid place where they can be beaten over the course of 2022. But I think we do have a little bit of downside risk still remaining to the margin story.
Gina, we're 1% from record highs as a general statement, and we may be there just by the time you get off air here and go check your children. But Gina, you know, what I find so important here in the humbling of the bears is the idea of margin compression. Have you, in the mix of your economics and all of Bloomberg Intelligence, have you amended how much the margin will compress on price as compares to earnings?
Yeah, I mean, margins are incredibly important, actually, with respect to driving price trends for the S&P 500. It's one of the things that we watch most persistently. But I think what the important point is margins, forward margin forecasts have to fall fairly precipitously before it starts to degrade your price outlook. And we're just not seeing that yet. We've been on watch for it.
Give me some big figures. I mean, come on, this is important, Gina. I mean, are you talking on a random 22 that you got to go to 21.8? Or are you talking about going from 22 to 19 on a PE ratio?
Yeah. No, it actually, margins I don't think will impact PE as much as many people had anticipated because we're not seeing a downdraft overall. You've got to see margins fall at least 150, 200 basis points for the index at large. And that's the point I'm trying to make is this is a company-specific, sector-specific issue right now. So you are seeing margin downdrafts impact groups within the S&P 500. Household and personal products is the first one that comes to mind. Some of the food companies have experienced margin pressure, certainly. But it's not pervasive. You're still seeing, for instance, energy companies are experiencing incredible margin expansion. Financials companies also posting margin expansion with the yield curve rising. So there are offsets, and you've got to, instead of experiencing these bits and pieces of the index experience with margin pressure, you really need to see it much more profoundly impact the index at large, and we're just not seeing that yet. I would give it a bogey of something like 200 basis points for the index forward 12-month operating margin line to fall before we start to see really strong pressures in price emerge.
Gina, before we let you go, we've been talking all morning about how it becomes a stock picker's market because of the dispersion, the churn under this headline number. Is that the case, or is it better to actually go with the index because it's buoyed by all of these different levers that are being pulled on all sides of the market?
I think it's a sector picker's market. And the reason I say that is because you do have certain segments of the market do very, very well in an environment where growth is slowing and inflation is accelerating, energy and financials in particular. And it matters less which companies within energies and financials that you pick than it does just being in those sectors. And I think the longer term research would suggest that 50% of any individual stock's return over time is from a sector. At this point in time, that sector selection is incredibly important. Beyond that, I do think within the lagging sectors, picking the right stocks is incredibly important as well. So you've got sectors like consumer staples, which is under pretty significant margin pressure. Consumer discretionary, similar margin pressures emerging. Picking the right auto company in an environment where autos overall are struggling with higher energy prices is going to be very important and certainly additive to portfolio performance.
Gina, great to catch up with you, as always. Gina Martin-Adams there of Bloomberg Intelligence, the constructive view on this equity market. Just trying to dig through the release from Procter & Gamble this morning, Tom. The numbers are okay. Core EPS 161, the estimate 159, net sales okay, the guidance okay in line. But Tom, you dig through the release and you start to see this stuff on costs, on prices, and you wonder how difficult things will be into next year.
Well, it's going to be a story there. And again, what I've heard this morning, John, and frankly yesterday, even within the optimism, it is about stock selection right now.
Up 21 on the broader market, the equity market advancing 0.5% on the S&P. On radio, on TV, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The UK will allow London Heathrow Airport to increase ticket surcharges by as much as 56%. Heathrow has been at odds with airlines for months after seeking to increase charges by as much as 95% to recover from the COVID-19 pandemic. Airlines have denounced higher fees as they tried to bounce back from the downturn. Now, the FDA is reportedly planning to allow a mix and match approach for COVID booster vaccines. The agency could act as soon as this week. It is likely to not recommend one vaccine over another, but may say it's preferable to use the same vaccine when possible. Moderna's CEO told us the company expects an FDA decision soon. An elderly couple who broke COVID-19 rules to enjoy China's tourist sites have become the focus of the country's latest virus cluster. Huge contact tracing and testing efforts are now underway after the two retired university lecturers from Shanghai continued to travel even after being told their test results were abnormal. More than 1,500 close contacts have been identified, and at least 6 new virus cases have been confirmed. North Korea has fired what appears to be at least one ballistic missile for the first time in about 2 years. South Korea's military described the weapon as one designed for submarine-based launches. It's the latest in a series of tests by North Korean leader Kim Jong-un's regime. The launch came hours after the U.S. reaffirmed its offer to resume diplomacy on North Korea's nuclear weapons program. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
tinatanggap ko po ang inyong nominasyon sa akin bilang kandidato sa pagkapangulo ng Republika ng Pilipinas. I am a fighter, and I will always be a fighter inside and outside the ring.
Do you consider yourself a filmmaker, a historian, an educator?
Well, you know, the biggest thing is that I'm a filmmaker, and that means I tell stories, and the way a painter might choose to work in oil as opposed to watercolors, I choose to work in history.
When you look at technology, how should we be looking at big banks and technology?
Technology is our friend. So it's helping us transform the bank fundamentally. And in fact, we're speaking, I think, as we speak, to our shareholders around what we've done and how we've transformed the bank. We also see technology and technology companies as partners. So some
Not
of our
rivals.
You know, we know that there are big parts of what have been our business historically that will be absorbed into convenience platforms. And by convenience platforms, whether that's Amazon or Facebook or Alibaba or Tencent or something like that, those are platforms that are just very convenient for people to conduct their day-to-day financial affairs. And it'd be very difficult for a bank to compete with that. Now, in some cases, I'd say, let's say in Africa, we are setting up a competing platform to the convenience platforms. And we're working with technology companies and mobile telephony companies and others to create a platform of our own. But for the most part, we're going to be playing on somebody else's platform.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
There's always a balance between the free speech and being responsible and taking down content that we think could lead to some kind of real-world harm.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
We've made clear our concerns about the military capabilities that the PRC continues to pursue, and we have been consistent in our approach with China. We welcome stiff competition, but do not want that competition to veer into conflict, and that is certainly what we convey privately as well.
White House Press Secretary there, Jen Psaki from New York City this morning. Good morning. Tom Keene, Lisa Abramowitz and Jonathan Ferro. Your equity market with a lift again. 4 days of gains into Tuesday. We had some weight to the S&P 500. Up 24, up 0.5%. In the bond market, yields come in just a little bit to 159.67. Almost unchanged there. In foreign exchange, euro stronger, dollar weaker, 116.61. Commodity prices heading north, surprise, surprise. 83.50, up another $1 on WTI, up 1.29%. So let's talk about costs and let's go to Procter & Gamble. In the pre-market, just a little bit softer following earnings. Here's the cheat guide to earnings at the moment for this earnings season. Get the press release, then search for the word margins. And Tom, for Procter & Gamble, it reads as follows. Net earnings declined as the increase in net sales was more than offset by a reduction in operating margin due to higher commodity and freight costs as anticipated, and most people, Tom, anticipating the same thing.
And John, I know you're keeping them in float with your endless purchase, I should say, at $100 a bottle of the sandalwood and cypress cologne from the art of shaving. But what we got here is a serious, boring, non-tech company struggling to keep margins. And their press release, John, really is informative about pricing power. And that's what Gina Martin Adams and others are going to do. They're going to go inside the data, and they're going to look at the interior of the company and what is the pricing power segment to segment. In their case, beauty, I believe, not so good. Shaving care, held up by John Ferro, really good.
Clearly shaving, Tom. so much.
Yes.
So much. To your point, though, Tom, here's the conversation where it starts. How much of those sales will fall to the bottom line? That's about margins. The pricing power story, Tom, that's held up through this year. Beyond just staples, there's been some confidence there that S&P 500 companies can continue that trend into next year. That's what will settle this story, this battle between the bears and the bulls right now in this equity market. What the guidance through earnings season looks like, and according to Dow Jones this morning, Tom, it looks like some price hikes of that company are coming again.
And really importantly, folks, we're going to focus on all of the sectors and all of the, to be honest, the major companies like PG, away from the romance, John, of following Apple Computer. I mean, we can add value there, but there's more out there than just the big five FANG stocks.
Well, Apple, of course, have got their own difficulties based on our reporting, Tom. They've got the demand. They can't get the supply because they can't put the things together. Never mind the cost. They can't find the supply because they literally can't get the chips, Tom, to put in the phones.
I'm pleased to announce I don't need a new MacBook Pro, but John, I was blown away by the chip engineering that they announced yesterday.
What do you make of that, Tom, going in-house that way?
It's proving to be successful so far, and I believe the Intel leadership has said we're going to fight back. Full disclosure, I just bought a Mac with an Intel architecture, but John, people, the heat of enthusiasm over the progression of the 3M chips is extraordinary. I've never seen it.
This morning, Tom, just quickly, negative 1.22%. No big moves here, but that's the story we're following through this earnings season.
Yeah, absolutely. Pricing power is what I'm watching.
You're going to get to our guest, Tom.
Let's get to our guest. She's in Washington. She uses all the PG products. Anne-Marie Horton joins us, Bloomberg Washington correspondent. Anne-Marie, you love to go over to the White House and see the president do the press conference thing, but the real news is in the back halls and in the Roosevelt Room. What is the president's agenda today?
Today he's going to be meeting with the two different factions of his party. So first he'll meet with the House progressives, and then later in the afternoon bicameral, which is House and Senate of the moderates. And he is just trying to find a middle ground between these two groups to push his agenda forward. This comes on the heels of a number of meetings yesterday as well. Senator Joe Manchin of West Virginia met with Senator Bernie Sanders, who had a bit of a war of words over the weekend. They actually posed for a photo and were talking to the press as they left. So it did seem a little bit more friendly than we heard over the weekend. Senator Joe Manchin also meeting with the chair of the House Progressive Caucus, Pramila Jayapal. So there are a lot of talks, but we still don't know yet what's going to go into this package, what for sure is going to get cut. And then there's that question mark of Kyrsten Sinema. She does not negotiate in public. When I asked the president directly about her, he said he's not going to talk about what she has shared with him in public. What does she want, and where's her line? That is still a question mark here in Washington.
How many Sinemas are there in Washington? Is she lonely, or are there others that are quiet like she is?
The thing is there's a number of people in the House who could be like Kyrsten Sinema, but the thing with the House is that you don't have as much power as you are with an individual senator. So let's take it to the Senate. I would say that a number of people want to move forward, a number of people want to have a compromise, and in the Sinema area, it really would be her and Joe Manchin. But we know what Joe Manchin, we know what his lines are. There was a report over the summer about what he said to Senator Chuck Schumer about where his red lines were. That has been circulated. He talks to the press about it. She's really more so the question mark.
Meanwhile, as we were just talking about, I do want to shift gears a little bit to supply chain disruptions, considering that every earnings report that we get mentions them. It's not just the cost of commodities like food. It's also the fact that you've got the likes of Procter & Gamble saying that they took a more than $2 billion cost on the higher prices from commodities. How is this administration dovetailing that message right now, considering the fact that they need more oil to keep the prices down politically and at the same time want to have an agenda that is respectable heading into COP26?
It's a great question. I'm actually going to be speaking to the Deputy Secretary for the Department of Energy today, and this is one of my questions for him. On the first part, we do know that the president is trying to ease up some of the supply chains. We spoke about that last week, but by and large, the government doesn't have a lot of control over these supply chains. These are private sectors. When it comes to commodities, this is something that the entire world is dealing with, this upshoot of commodity prices, and we're seeing that in the market today. This administration is holding talks about the rise in oil prices, because what does it mean for U.S. consumers? it's a very fine line they need to walk, because the fossil fuel industry would say that this administration has been hostile towards them. There's still a ban on federal drilling. They killed Keystone Pipeline and the likes, and they want to move this economy. They want to transform it to a greener economy. At the same time, how do you do that in a safe way that also insulates consumers from higher energy costs? That is a line that they are going to have to walk, and you're seeing it play out in Washington just with the president's own domestic agenda. This is at the heart of really what Senator Manchin is talking about when he says he's not going to sign up for that clean electricity program, because he wants to still continue to use coal in West Virginia. So this is really a tough question for the administration, and it comes at a very precarious point for the president, because he is potentially going into COP26 with an empty bag.
Anne-Marie, thank you. Our Washington correspondent down in D.C. Going into this climate change conference at the end of this month, Tom, I just wonder what he says to the Europeans as well, after the Russians have signaled that they're not going to boost the gas supply if they're against Nord Stream 2. That's the latest news this morning. Of course, we've heard that message on repeat from the Russians. It's hardly surprising, Tom, but in a moment like this one, it carries more significance.
Yes, John, and don't forget the Chinese as well may come in here and adjust the dialogue, let's say, at COP26. We'll have complete coverage of that. John, I'll tell you, to me, there's a lot of backstories, and as I mentioned before, the number one is these elites have to talk to the rest of the world who is skeptical.
Have you booked your flights yet?
No, I'm talking about it. I may get the Gulfstream. I'm actually pleased.
I think he was going up to Scotland. Just not sure if it's been approved yet.
Yeah.
Never is.
Every other place.
It's either the Gulfstream or Icelandic Air through Raven.
Okay. I've done that, Tom. Tom Keene, Lisa Bramis, and Jonathan Ferro. This is Bloomberg.
China's growth because it is already slowing. Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, part delays, chip shortages, settled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, You can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This equity market keeps on rallying. Live from New York City. For our audience worldwide, this is Bloomberg Surveillance. Up another 27 on the S&P, advancing 0.6%. Similar story on the Russell, the small caps on the Nasdaq too. The Nasdaq up 0.5%. The small caps up almost 1 full percentage point. 4 days of gains into Tuesday. We add a little bit more weight to it. That's the story in the equity market. We'll run you through the earnings story through the next couple of hours on Bloomberg TV and radio. Here's the story in the commodity market. Switch up the board.
Hello, traders. Are you ready to trade Bitcoin? Okay, I am placing an order to sell Bitcoin at 62,290. Okay, 62,290. Okay, let's see. Where 62,290, just right here. Order placed. You got the strategy. All of you guys who using our strategy, we spotted this opportunity to trade Bitcoin. Please copy this trade and stay with me. Order placed. Okay, as soon as it get filled, I'll let you know what we're going to do next. For other people, if you want to get the strategy, please go to companyeye.co.uk and you can get the strategy from our website. Okay, guys, stay safe. Yeah, I'll speak to you later.
That's the commodity market. Let's finish on the bond market. Treasuries, 2s, 10s and 30s. Lisa went through the Fed speak today. I know you can hardly wait. Lisa, every time I talk about the Fed speak, I have to almost pause because I know a lot of people are so frustrated from hearing from these Fed speakers. You will hear from them again. 159.15 yields in a basis point. Lisa, excited to hear from them.
Okay, look, what are they going to say at this point? Honestly, what guidance can they give that they have not already given? And frankly, what kind of unification, who matters on the Fed at this point, given some of the churn there?
I think, and I said this earlier with regards to Russia, you can repeat the same message, but if the situation around you changes, the significance of what you say is not the same. And I think on a day like today, if everyone gets together and keeps beating this drum, that there is a difference between tapering and interest rate hikes, that the difference between the time between the two will be a lot longer than you think. Tom, that's important in the context of a 2-year yield that's doubled in about 6 weeks.
I'm just guessing, John, but I mentioned this earlier. Maybe we see a change in Fed dialogue today that adjusts all the rate guessing that's going out there now in the Fed parlor game. Right now to the parlor game, Subrata Rajappa joins us, head of U.S. rates strategy at SocGen. Thrilled we could get an update here. Subrata, how important is the adjustment in the Fed message? Do they have to catch up where the market is on maybe a slower growth and maybe a more controlled inflation?
Not really. I think that for the most part, you're going to consistently hear the same message from all the Fed speakers that they're probably going to be very careful and cautious on rate hikes because of the fact that they just don't have enough information on the inflation front for them to sort of guide the markets towards rate hikes. And that's why I think you're seeing a little bit of an adjustment in the 2-year part of the curve this morning. We did see the market fully priced in 3 hikes by the end of 2023. And now you're going to see a little bit of adjustment based on what the Fed's saying.
Equities are on a tear. What does that signal to you in an overarching strategy, and particularly in fixed income?
Well, I think that low yields are here to stay. As long as yields are low, real yields remain low, then you have to go out the risk spectrum and invest in higher yielding assets. So if you look at the bond market complex, whether it be high yield or treasuries on the other end of the spectrum, your real returns are very, very low. I mean, in treasuries, you're getting negative 90 basis points. So it just doesn't make any sense to be in bonds, and you're better off investing out the spectrum. And that's why you're seeing more and more demand, if you will, for risky assets, as well as corporate bonds and high yielding bonds, in an environment where treasury yields are going to potentially remain low for the foreseeable future.
Subhadra, I want to sit on the Federal Reserve for a minute. The idea here that they inevitably will push back on some of the rate hiking expectations that are being built into markets. Would they embrace this? I mean, markets are still chugging along even as traders price in 2 rate hikes. Don't they want to propagate that because it gives them, frankly, more ammunition down the line to either ease without even moving the rate just by verbal intervention, or down the line, it does leave them the ability to cut because rates will not be at 0?
So I think the way I would look at it is, I think monetary policy, especially rate hikes, is a very blunt tool in this environment, right? You're looking at a very unusual inflationary environment that's driven by supply chain disruptions and labor shortages, higher rents. The Fed can't really meaningfully do anything by raising rates to sort of fix the inflation problem that we're going through right now. So I think the best course of action for the Fed is to remain patient until it really, really needs to raise rates. So that's why I think they're going to err on the side of the caution, because they know they can pivot easily to guiding the markets towards rate hikes if they need to. If they do it now, then what you're going to see is this sort of price action you're seeing in the bond market, where the bond market thinks that the Fed is going to be able to raise rates sooner, faster, kind of front load the rate hikes, if you will, which would imply a much slower trajectory for growth over the longer run. And that's causing this extreme flattening of the curve. They don't really want that either. Steepening of the curve is healthy for a variety of the sectors of the economy. So they just aren't, they shouldn't really be in a rush, if you will, to sort of guide the markets towards rate hikes.
There's also the idea of political risk, that this is the perhaps view of the Federal Reserve as it is composed today. Yet we really haven't heard from President Biden in terms of replacing Fed Chair Jay Powell, an increasing question. If you look at Predicted, the odds have actually been going down. What's your view of the potential market risk of turmoil at the top of the Fed?
Yes, there's more uncertainty now than there was probably even a few weeks back about who's going to be chairing the Fed and what the composition of the committee is going to be next year. But broadly speaking, I think that regardless of the choices that are made, I think, most presidents want a very dovish Fed. They want policy to be accommodative so that, so that they see robust growth trajectory and the labor market is strong and inflation is not a concern. So I think broadly speaking, the composition is going to remain somewhat dovish, even if there are new choices made for the chair as well as some of the committee members. So I think that policy, especially with the Fed, tends to be somewhat stable. So I think that I'm not nearly as concerned about the change in leadership, if you will.
How does this devolve into the equity market? I know it's off your remit, but the gloom crew, Subhadra, has been absolutely crushed in the last 10 days. How do you adapt to that? How does it change your perspective?
By gloom crew, you mean the people that expect the equity market
the narratives,
to turn
this
over?
fear, that fear, whatever the fears are in bonds or stocks, they've been obliterated.
It's interesting because it has happened within the context of the bond market being concerned about very, higher trajectory to inflation, the bond market being concerned about the Fed raising rates. So the equity market, for the most part, is dismissing all the signals that the bond market's sending on the fact that the front end yields have gone up with a faster pace of rate hikes. There's probably a potential slowdown in growth. So I think the equity market is going to wait. I mean, I'm not an equity strategist, but I think that really the signal that I'm getting from the equity market is that they want to see and hear from the Fed before they start pricing in sort of this doomsday scenario. And the bond market always tends to lead, if you will, in some respects. So the signal from the bond market is going to be very key for all the other risky assets.
Subhadra, you are perfectly entitled to talk about the equity market, since equity strategists have spent the whole of this year pretending to be bond market strategists pretty much all of this year. Subhadra, thank you, as always. Subhadra Japa there of SocGen. And it didn't really help either, did it, Tom? Yields up, the market's up. At the front end, yields are doubled, and the market's up big time.
We're in a natural disaster. Okay, I think we all know that. There's people here really with some immense challenges. And John, I don't know how you do conventional strategy right now.
No idea.
Just make it up
into next year. Give me a forecast, Tom.
I'm trying to get to December right
exactly.
now.
I'm trying to get to November. Never mind that. I tell you what, though, Tom, this Chairman Powell thing is getting really, really testy. Jason Furman was out on Twitter yesterday evening.
Yeah.
This is former President Obama's former chairman of his Council of Economic Advisors, suggesting people look into Senator Warren's financial disclosures. A ton of snark in the tweet. You can read it for yourself, Tom. But it's getting a little bit testy now. This needs to be settled.
It is. And what I have been surprised by, full disclosure, is where the Fed hasn't come out and discerned this person from that person. Maybe we await that. Maybe we see that. But, is it all trading? Maybe not.
What do you think the president is waiting for, Lisa? Always dangerous to try and guess what people are thinking.
But you're British.
But we're sitting around here waiting and waiting and waiting. Are we waiting to see them finalize the fiscal package on DC before we get the next steps for what this Federal Reserve looks like next year?
Look, I don't want to speculate, but that's where my mind went also, that basically he's trying to toe a line right now with progressives that are really pushing the other direction and taking a hard line when it comes to the what was $3.5 trillion deal, maybe $2.5 trillion deal that they're trying to get passed. Look, I think that the whole issue around Fed trading goes to the heart of this skepticism in the public about the Federal Reserve's role and power, frankly, in a market that has been boosted again and again in a way that benefits people who have some assets in the market.
Yep.
And this is a political issue, and it has a lot of emotion attached to it. And so, frankly, even if you say, look at the details, it might seem okay. It doesn't matter even, because it is such an emotionally charged debate with people who fundamentally have skepticism.
Are you
about the
emotional
Federal Reserve.
about the Federal Reserve, Lisa? I know you get emotional about this Federal Reserve. The irony of all of this, Tom, is that the current chairman of the Federal Reserve has been more dovish than the president's own Treasury Secretary was when she was the chair of the Federal Reserve.
Yes. Be careful what you wish for.
Tom Keene, Lisa Bramett, and Jonathan Ferro. Equity futures up 21, advancing 0.5% from New York City on radio, on TV. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Russia is hinting that it will not go out of its way to offer European customers extra gas to ease the current energy crisis unless it gets something in return. Regulatory approval to start shipments through the controversial Nord Stream 2 pipeline. On Monday, the pipeline's operator said its first line is full of so-called technical gas and is ready to begin operation, though it cannot ship it until approval is granted. Now, Britain has ordered a review of the planned $8.7 billion takeover of aerospace and defense firm Meggitt by US-based Parker Hannifin, citing national security concerns. Meggitt is one of the last independent British aerospace suppliers, with customers including Boeing and Airbus. Prime Minister Boris Johnson's government has said it would increase scrutiny of defense takeovers after a flurry of M&A in the sector. Bloomberg has learned that Credit Suisse is nearing an agreement with the US government that would resolve a criminal probe regarding its role in a $2 billion Mozambique bond scandal. The ongoing legal saga stems from the 2013-14 deals that were supposed to fund a new coastal patrol force and tuna fishing fleet in Mozambique, one of the world's poorest countries. Barclays' return to office is well underway. In New York, at least, CEO Jez Staley tells Bloomberg that the majority of US employees are back in the office. Staff are required to be vaccinated to return to Barclays offices, and more than 90% are. He added that while flexible working is, quote, here to stay, he believes there is growing momentum around people returning to the office. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Is inflation really transitory, or is there a risk that because we believe it's not transitory, it actually becomes sticky?
I think central banks are really worried about inflation now. Much of what we see probably is transitory, but nevertheless, it's a lot easier to see upside risks to inflation than downside risks. None of us know where inflation will go over the next year or so, but upside risks are coming, I think, from three sources. One, as we gradually learn to live with COVID-19, the bottleneck effects are pushing up some prices. Secondly, energy prices, we've seen, even yesterday, they moved all over the place for gas prices. We don't know where they'll go, but it's much easier to see upside risks than downside risks. And third, and I think one which is very different from the past 20, 30 years, is that the political risks are also much stronger. There's real pressure now to boost public spending, but not to raise taxes to finance it.
From New York City.
We're here in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Google is saying it has accelerated innovation in the country, and it's planning to appeal the FTC's decision. What's your take on this, and how do you plan for further scrutinies?
We are going to see what they make and what changes they are actually bring to this market.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
The role of the central bank was to provide marginal liquidity at the times of crisis, and then to withdraw it after the economy started to stabilize and come back. The central banks are now running the markets.
It is hard to disagree with that statement there from Scott Minerd, the Guggenheim CIO. From New York City this morning, good morning. Tom Keene, Lisa Abramowitz and Jonathan Ferro. This Tuesday morning, we add some weight to this rally again. 4 days of gains, could it be 5? Up another 22, advancing 0.5%. Yields coming in just a little bit below 160, 159.32. In the FX market, euro stronger, dollar weaker, 116.58. And crude approaching 84 again, through 83, 83.35. Up 90 cents on the session, Tom, up by 1.1%.
Watching equities, they pulled back a little bit in the last hour, but we are watching this lift to the markets. As always, David Wilson is, yes, earnings, yes, charts. What do you have today?
Well, today it's all about Bitcoin, right? I mean, we have this first U.S. exchange-traded fund, the ProShares Bitcoin Strategy ETF coming out. So, you know, it's not really the first of its type, though. You go back and you look at, say, the U.S. Oil Fund as an example. It's another ETF that's set up to own futures contracts as opposed to the actual asset. I mean, that's the way this ProShares ETF is organized. And the history suggests there's a real challenge in terms of keeping up with the performance of the underlying asset. Oil, of course, West Texas Intermediate crude for the U.S. Oil Fund. And, you know, you look historically, I mean, you look at their prospectus, and it says they want to be within 10% of the average daily price change in WTI over a 30 trading day period.
What does Bitcoin say?
Well, I mean, as far as that goes, we'll see how they set it up. But for the moment, I mean, what really is interesting here is if you look over the history of the U.S. Oil Fund ETF, which goes back to 2006, it's down 90% over that time. And you're not seeing anything like that with crude. Certainly it did last year when it turned negative, but at the moment it's actually up 20% over the period for which this ETF has been trading. So it just kind of tells you the challenges that this new Bitcoin ETF is going to face. It's all about futures contracts and the costs that go along with moving from one month to another, that sort of thing.
This is a hugely important point, folks, and only David Wilson can bring that insight. The costs of doing business for an exchange-traded fund. Bitcoin's cost-free. We go to Edward Vanderwald in London right now with all the joy of Bitcoin as well. What do these ETFs do, Edward, if Bitcoin goes from 62 to 52, or for that matter, from 62 to 72?
Yeah, look, I think this is the problem for Bitcoin, right? For the investors who take this position, because David makes a really good point. It is futures. It's backed by a futures contract, but not only backed by a futures contract. It's backed by a cash settled futures contract, right? So what you're really doing is you're taking demand away. Somebody who might have wanted to go out and buy Bitcoin is now taking exposure to a cash settled product. So there's no necessary exposure to the underlying Bitcoin. So this really, in the long term, while it's bullish in the short term, I think it drains away some of the demand. And I mean, you're right that it's very hard for these ETFs to completely replicate the price moves in that way. And I think we saw with oil, when it went negative last year, just how much there can be a cross-contamination from these markets.
These are not synthetics, and they're not CDO squareds. But is this financial engineering because there's no underlying?
Yeah, I think it is in a way, right? And I think some of the investors that take the exposure, some of the investors that hold the short exposure on that futures contract, yes, they will lay off that exposure by owning some Bitcoin, but there's no guarantee that they will do so. So in the long term, the bigger that a product like this gets, the more it drains demand away from Bitcoin. And Bitcoin ultimately has no use case still, right? We're not seeing people use it really in the economy except for in El Salvador. And even there, it's kind of doubtful how much it is being used. So I think this is a real problem for Bitcoin. It has been from the start. The options contract, remember when the original futures contract launched, that was when it was within days that the Bitcoin price peaked in 2017. Now we may see some follow-through buying here. We may see the price push through that record high and then momentum carrying it through. But ultimately, I think in the long term, this is a bearish development if this contract grows.
But Eddie, let's take a step back for a second. I mean, we could have a philosophical discussion about Bitcoin and what its legitimacy is in this world. However, that's actually not the point, especially when you speak with JP Morgan's Jamie Dimon, who says he personally thinks it's worthless, but his clients want it, so they're creating a desk. Basically, doesn't the advent of something like this generate more demand by making it more legitimate in the eyes of regulators and institutional investors?
Lisa, absolutely, and ultimately that is the case, right? As long as there is demand for it, people will use it. But this is different from a physical commodity. This is different from a bond. What do investors want? They want price exposure. The futures contract can give that to them in an almost perfect way, and so can the ETF. Right? So you're creating a perfect substitute for the underlying. The oil contract is not a perfect substitute for the underlying. Ultimately, there is somebody who needs, crude to keep his refinery turning, and we need crude for all sorts of other things to keep the economy running. So ultimately, there's an underlying use. But what we are creating here is something that is a perfect substitute for the underlying, and therefore it can draw demand away from the underlying. We've seen that in gold.
All right, so going forward, what's your expectation in terms of how the entire industry will evolve, considering that every ETF provider is looking to get into this space?
Oh, I think this may be the thin edge of the wedge. I think if we see Bitcoin-backed ETFs coming in, you know, and being accepted in the US, that is a much more bullish development, and that we are already seeing that in other places. And I think, you know, I think it's very hard to say, okay, we've done this for a year or so with a futures-backed fund, and then say, well, okay, but we don't want a Bitcoin-backed ETF as well. So I think this may lead to that full acceptance. And we are seeing Bitcoin more and more being accepted in the wider financial markets. But for that reason, it's interesting.
Got to leave it there, Eddie. Always good to hear from you, sir. Eddie van der Velde there.
Thank
on
you.
Bitcoin, just short of an all-time high, the record back in April, in and around 64. Tom, this morning, XBT on a Bloomberg, 62K.
We are efforting Charles Mackey to discuss this here in the coming weeks as well. John, you know, I look at this and I'm sorry, I'm going to go to the underlying. What's the underlying? I mean, the underlying is a future. Is the underlying the tangible, the Bitcoin? And for that matter, what's the underlying of actual Bitcoin?
The underlying story here, though, for me, Tom, is that we've made some progress with this asset class in a way that I didn't foresee years ago. And at a time when we thought the regulator would clamp down on various activities, haven't seen much yet, have we?
I think they will wait. My experience with the regulation, John, is they will wait to the event. They need to see some form of event where they justify regulation.
Bitcoin this morning at 1.4%.
It's 62,000. They haven't seen the bad news yet.
Through 62K in a big way. Tom Keene, Lisa Brabbits and Jonathan Ferro. Your equity market up 22, advancing 0.5% this Tuesday morning. Good morning to you all worldwide. Heard on radio, seen on TV. This is Bloomberg Surveillance.
As Magnus TV in Facebook since I'm streaming Axie Infinity. Axie Infinity is an NFT game where you can earn tokens, and then that tokens can be converted into pesos. I'm playing almost 4 to 5 hours a day. I'm earning, I can say it's really a lot of money. It can help to sustain my family needs and also to sustain my own business that I'm starting. I'm a little bit worried about it because some people who join this Axie Infinity thinking that this is an easy money game. They can earn a lot on this game. This game can sustain their life. And I think that is not the point, or that is not really the game. We are trying now to build a community where other players or my scholars can join this esport, playing Axie Infinity for now, even 5 years, I think.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time
that I... What did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Do you consider yourself a filmmaker, a historian, an educator?
Well, you know, the biggest thing is that I'm a filmmaker, and that means I tell stories. And the way a painter might choose to work in oil as opposed to watercolors, I choose to work in history.
You're looking at the Fed, probably is on hold next year still. I think maybe you get one hike, but I don't see 2 hikes next year at all.
Central banks have very little latitude and flexibility to say, no, we really cannot hike.
Central banks aren't very good at being nimble when they're trying to catch up from being behind the curve.
At the end of the day, the balance sheets are fine. The consumers are in great shape. The appetite is very, very healthy.
If we slow to 3% next year, we're still growing well above potential.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. A most interesting day. Some earnings coming out as well. A market lift that has a different character to it. John, it's a market lift wrapped around Fed speak.
Where did the equity bears go, Tom? 4 days of gains into Tuesday, up another 0.5% on the S&P, striking distance of all-time highs on the S&P 500. And the Fed speak, Tom, front and center, because we're doing this with increasing bets of rate hikes at the Fed next year.
Yeah, it's going to be interesting to see how they do. Do they reaffirm? Now, they're going to separate taper from rates. I think, John, I'm more focused on the rate chat than the taper chat.
Oh, totally, Tom. Taper chat's done. November 3rd, let's go. Let's go. Let's have a conversation about interest rates. Fact of the matter is, we know what the objective is. They've not been successful, Tom. The objective is to separate the taper talk from rate hike guidance. They've not been successful because we're increasingly pricing in interest rate hikes. That's what you'd think they need to push back against this week.
This new phrase, slugflation, Lisa, to me, it's about slower growth. And you wonder, is there a fiscal drag if Washington gets nothing done on infrastructure, nothing done on some form of social programs?
And frankly, even if they do get something done, the fact that it will be drawn out over many years, we're getting the roll-off of a lot of the fiscal support that we got from the pandemic. When the debate around the Fed, though, really hinges on the lack of knowns. I mean, how could you speak with conviction, Tom, about an inflationary backdrop that no one fully understands? We don't know how much is being driven by supply-side dynamics versus demand-side dynamics, and that matters tremendously for a Federal Reserve.
Now, John, I really want to stop the show here. We're advantaged, as you know, by Mark Gurman, who's flat out the #1 person in the world on Apple and all that. John, you know I've been talking about technology and our underestimation of it. This is from the production expert this morning. It's a first look at the engineering that Cook and Cupertino have done. Geekbench and John Poole say this new toy, John, which you need, nears the performance of the 12-core cheese grater. All you got to know in consumer speak is this thing's a beast. And, John, we underestimate that going into 2025.
Do I need the screen cleaning cloth, Tom?
$19.
For $19. Lisa,
Absolutely.
I mean, come on. I sit here and I laugh, Tom. The problem is they'll be cutting that out in the earnings guide, won't they? In the PowerPoint. What would they call that?
They would call that
cleaning cloths or something.
Cleaning experience.
I mean,
for your
come
MacBook.
on.
I'm saying that the inequalities that we're talking about every day and the market guesses we're talking about have an overlay of technology, Lisa, that's unmeasurable. And you saw that yesterday beneath the headlines of Apple.
Although, to John's point, there is a limit to what people will pay. And really, it'll be interesting to see whether people will pay $19 for a cloth. The idea here that they tried to make an Apple Watch Premium that was something, how many thousands of dollars, and they had to retrench because people actually said, well, you know, the technology is going to be obsolete in 2 years.
The Hermes watch band helped out with that. Lisa, one of your offspring is going to be going, I need the loaded MacBook M1X or whatever. You know, this is like this weekend's conversation.
With the $19 cloth.
And when I say to them, you better clean the screen, they say, okay, I've got something for that. And I'm going to say, yeah, go get a cloth.
I've got this. It comes free with my glasses.
John.
They give you a cloth. What is that about, Tom?
It's it's what, hey, who am I to tell them about their
We're in the wrong
aesthetic?
business.
Yeah, we're in the wrong business.
We've got to make some, Tom.
Oh, there it is. Mark Gurman, thank you for your reporting on Apple. John, I'm reporting the data check, and I guess I got to say oil's cratered.
Cratered to what? 83? 83.25 right now. Bear in mind, Tom, there's people listening on radio. They might not get the sarcasm. Up 9/10, call it 1% on crude through 83, 83.27. Yields in a basis point, reversing some of the move in the bond market. 158.80. Bit of dollar weakness out there. Euro strength. Euro dollar 116.55. And Tom, can't get away from it. Equity futures just piling it on again, up 22, up a half of 1%. What was the drawdown? 5%, and now within 1% of all-time highs.
We've come up over 6% off the NASDAQ bottom as well. On radio out of New York and, of course, Boston, Washington, San Francisco, and all across this nation and truly around the world, we say good morning. And on radio and TV, it's about, okay, now what? Brent Schutte is Chief Investment Officer, okay, now what, at the Northwestern Mutual Company. Brett, what is the mood of your institutional and retail clientele that's worried, cautious, or flat out scared?
Yeah, we think there's been worries in the markets since about mid-May. So if you think back then, everything was going well in this country. Everything that we had tried to do over the prior year was kind of coming to fruition. So we had rising vaccination, declining COVID cases. And economic growth was strong. And I think people sat around and wondered what could go wrong. And so you had to worry about too much. Think the inflation commentary that we still have today and what would the Fed do? You had the too little crowd, China, Evergrande, would the economy roll over? And then valuations, are stocks too strong? Have they rallied too much? And we think that's really driven trading over the past few months. And we think that as you move towards the end of the year, investors will refocus on economic and earnings fundamentals, which will push stocks higher. And I think that's what you're seeing right now. Earnings are coming in strong. The economy is still strong. Certainly there has been a weak patch because of COVID, but I think that alleviates. And I think you're left with an economy that's moving higher, earnings that are strong, and a 10-year treasury still sitting around 160. Where are you going to put your money?
How important is that 160 piece in all of this?
It's important. I mean, if you think right now, I find the narrative kind of odd when people come on worried about inflation, saying the Fed's going to do nothing, and then they tell you to invest in bonds. To me, I still think there's plenty of room in equities. I think especially in the more cyclical areas, which I think we've all given up on after a brief 6-month rally in those versus things like the Apple $19 cloth that you were talking about.
Yeah.
I think that here and now in oil and places like that is where you want to invest. More so than the secular growers like you just mentioned.
I've been asking guests over the last week, Brent, what are the pillars of support that will persist, we can lean on through next year as well, not just into year end? BlackRock gave me 2. They said pent-up demand, that will persist, and pricing power. Do you share that view, Brent?
I do. If you look right now, for example, on the consumer side of the equation, the consumer has spent the prior 13 years deleveraging their balance sheet. Their debt to net worth has gone from 24 to 12. The cost of that debt has gone from 18 to 12. And so the consumer's healthy, they have pent-up demand, and I think you're going to continue to see spending. The question is going to be on these supply chains, can those snarls kind of alleviate a bit? And I think they will as you move into the new year. And so I think you have a setup where equities continue to push higher. There certainly are risks, and I don't expect the same push that you had post-COVID. But I think on a relative basis, stocks are still attractive relative to bonds, just given the economic outlook and where the Fed is.
Brent, when you were saying that there is a lot of pessimism in markets, where are you seeing that pessimism?
Yeah, for example, just the for client visits, the questions that I get are not what could go right, it's what could go wrong. And that's kind of a continual question that I get all the time because things have gone fairly well. But if you look at the AAII Bullish Sentiment Survey, it peaked around May. We kind of had all the meme stocks moving higher. We had people trading on a daily basis. We had optimism actually go above 50, which is kind of rare air during the past 13 years. And it spent the next 3 or 4 months falling to, I believe, 22 in September. It's starting to rise a bit again. And I think people are going to get warmed up to the fact that the economy is still pushing along. And that typically pulls markets with it. And I don't expect this time to be any different.
When you talk to clients and they hear from asset manager after asset manager, it's a stock picker's market. What do you tell them? Do you say, look, the index is doing pretty well. It's supported by a number of different pillars. Or do you say, yeah, you should be very selective or you should just pay very big fees to somebody to invest your money on a stock level?
We attempt to pull both levers. And so we attempt to add value through security selection and asset allocation. So we are overweighted small caps, for example, and we certainly do try to tilt our portfolio towards those cyclical names that I mentioned kind of in my opening comments.
Brent, always fantastic to catch up with you, sir. Very calm and constructive on the outlook. Brent Schutte there of Northwestern Mutual. I mentioned this quote a little bit earlier on the program. Allow me to do it again. Year to date, 88% of the S&P 500 members have experienced at least a 10% drawdown. Meanwhile, on a closing basis, the index has only corrected by 5%. That is a historical anomaly. That from Morgan Stanley, Tom.
Yeah.
A 5% move. That's been the maximum drawdown. And we're almost within 1% of all-time highs.
Yeah, and it's a rotation story here, but I say, John, I'm going to say it comes within the oddity of this natural disaster, a global pandemic, and part of it, again, is this overlay that, you know, did we see this 6 weeks ago? This commodity lift. Bart Malik, who's been around forever, with the Toronto Dominion Bank of Canada running their important commodities, John, he just recalibrates oil, once again, higher to $90 a barrel, but he's very cautious on China growth. And John, he vamps it into the Beijing 2022 Winter Olympics, where China's going to have to get their air pollution act together to have a good Olympics.
I've heard the
and
same
he
thing,
even
Tom.
says, you know, metals could come off the bid because of that. It's a very sophisticated note from TD Securities.
Well, Lisa, right now, metals have not come off the bid.
No, and actually this goes into the oil story in the sense that it's getting more expensive to produce oil, certainly in the shale patch. When you talk about the fact, John, you were saying OPEC can just bring more supply online, but can they as quickly as they're saying, because they've been raising production and not being able to meet it because there hasn't been investment in places like Nigeria, et cetera, that really are not able to meet the target. So this really raises a question about how much supply can meet the demand on a sort of incremental marginal basis.
This always comes down to two places, Saudi and Russia. Those two places alone. It's up to them. Well, they can do something big time when it comes to energy.
Yeah, the question is then, do they want to, given the fact that they have a lot of political reasons perhaps not to?
And this administration and their policies, Tom, they're caught up in the middle of it. And I'm not advocating for a particular view here, just stating a fact. They're right in the middle of this with some of their own views.
This is the province of Ed Morris, and, you know, frankly, his next note's going to be important on this, of the lift up, and then maybe the market recalibrates and we come back down as one fond hope.
$19. I mean, can we just wrap that one up? You're buying a $19 cloth to clean the screen.
It's an Apple cloth.
Oh, come on.
I'm buying Apple cloth
How much
features.
is the Mac? How much is the Mac?
The MacBook loaded, I bet you're up to 4,500.
So an extra 19, why not? Is that the view?
Yeah, well, you know, the child's day trading Bitcoins.
What's the margin on a $19 cloth?
Loaded is 6,000.
I know.
Tom Keene, Lisa
100%.
Bramis, and Jonathan Ferro. Futures up 0.5%.
It's a beast.
It's a nightmare for parents
I'm a
everywhere.
surveillance fanboy.
Yeah, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. As finance leaders met with British Prime Minister Boris Johnson's government to discuss the next wave of efforts to combat the climate crisis, they agreed that the problem needs markets and markets need new rules. Barclays CEO Jess Staley spoke exclusively with Bloomberg Television.
From the Prime Minister to the Chancellor, they want the UK to be a leader in addressing the climate issue. And they're dedicating the resources of the British government and the City of London in order to do that. So they want a leading role. They've got the ability to take a leading role. And the banking community and the finance community, I think, should be supportive of the British government in doing that.
Today's gathering has drawn criticism from climate campaign group Global Justice Now, who said the fossil fuel financing of attendees like BlackRock and JP Morgan undermined global attempts to fight climate change. President Biden will continue courting Democratic progressives and moderates today as he seeks to reach a deal to advance his economic agenda before the end of the month. West Virginia Democratic Senator Joe Manchin, whose vote is pivotal in the 50-50 Senate, said yesterday there's little chance that Congress complete work on Biden's agenda by the end of the month deadline set by party leaders.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
There's always a balance between the free speech and being responsible and taking down content that we think could lead to some kind of real-world harm.
What did you think at the low point of the Greek economic debacle? What were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms. And I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
There's no question that the bilateral relationship between the U.S. and China is complex, and it's going to continue to evolve. We're watching it closely, but with a long-term lens. China's an important part of the global economy. Goldman Sachs operates as a global player with businesses around the world that are participating in global growth. And so we think in the long term, that presence there will be very important for us.
Great to hear from David Solomon there, Goldman Sachs' chairman and CEO, sitting down with Francine Lacqua over in London. From New York City this morning, good morning, Tom Keene, Lisa Bravitz and Jonathan Ferro. Your equity market up 21, advancing 0.5%. There is a lift. 4 days of gains on the S&P, the longest winning streak going back to August. If that's worth anything to you, it could become 5. Yields are lower by a basis point to 158.80 on 10s, and crude is positive. It is higher, Tom, up 0.8%, $83 and let's call it 10 cents, up 60 cents on WTI on the session.
There we go. We will now stop the show, and we will talk about what it matters from sea to shining sea, whether you own or rent. Housing data today, starts permits. We see that here in, I think, 12 minutes, John. We go on to other housing data, and all that matters is OER, E-I-E-I-O. Lindsay Piggs, who joins us now, chief economist at Stifel. Lindsay, it's an 11-page document from BLS that explains OER. You're the only one I know who's read it. What is OER, and what's it mean for Chairman Powell, our listeners, our viewers?
Well, OER is owner's equivalent rent, which is the Fed's attempt to quantify the impact of rising shelter costs in the economy without pegging home purchases versus rental payments. So it's essentially trying to capture overall shelter costs. Now, for the Fed, this is creating somewhat of a conundrum because we have seen OER, shelter costs, on the rise. And the Fed continues to tell us, well, this is part of that transitory component of inflation.
Okay, stop there. That's where it's right. Stop there. How in God's name is rent transitory?
Rent itself, they're not saying is transitory. As consumers, as businesses, we feel that right away. We pay rent on a monthly basis, save for the short period where we did see the moratorium on eviction/rents. But from a monetary policy standpoint, what the Fed is saying is that the pressures on rental costs, the pressures on food costs, the pressures on lumber costs, these pressures will prove transitory as the economy recalibrates to a new normal level, as businesses are able to access supplies and materials because supply chain disruptions are smoothed out. So the Fed is saying from a monetary policy standpoint, this is just a matter of patience. It's not a matter of adjusting policy to correct these disruptions that we're seeing on a temporary basis as the result of recovering from a global pandemic.
That said, Lindsay, it seems like the rent inflation really got the attention of Fed officials more than other types of inflation. Why is this potentially more concerning to members of the Fed rather than, say, energy costs or the price of milk?
Well, I think the price of milk certainly is a very big concern. When we see food prices rise, Fed officials do get concerned. But again, we're very used to volatility in food and energy costs, which is why we often exclude them from the inflation metrics and look at the underlying core measure. When we say core, that's excluding food and energy. But underlying rental costs, this is a large component, or housing costs, I should say, is an extremely large component of the overall household balance sheet. And if we start to see these prices rise, this could very quickly eat into consumers' ability to go out into the marketplace and use available discretionary income to make purchases of goods and services, thus undermining demand and, by extension then, potentially the broader recovery.
Lindsay, you said that basically this is something that Fed officials, that central bankers don't have control over because this is a supply side story and these have to do with disruptions that will eventually abate. At what point do central bankers have to pay more attention and say, we have to respond, even if it's not our fault, and frankly, even if we can't really get ahead of it directly, but perhaps indirectly can take some of the froth or the heat out of the market?
Well, I think we're at that point. I think Fed officials have been very clear that at this point it is appropriate to begin to roll back some of those emergency measures put in place to combat weakness as a result of a global pandemic. But at this point, the consumer is still on very solid footing. Yes, losing some momentum from the start of the year, but still very solid footing. We see the housing market very strong, manufacturing well above expansionary break-evens. We see a number of sectors really signaling that the U.S. economy is on sustainable footing. And so the question for the Fed is, what problem are you trying to solve by continuing these emergency measures? And I think for many Fed officials, they're saying that there isn't a problem.
With that said, then, what is your glide path back to potential GDP? Just in the maelstrom of the gloom of 6 weeks ago versus where the equity market is now, the VIX 16.00. Lindsay, have you extended out the path from a boom economy back to whatever normal is?
We haven't adjusted our forecast very much. I think in looking at street forecasts, we've actually seen expectations come down more near our realistic expectation. I don't want to say pessimistic, but let's say realistic. We did anticipate for quite some time that momentum would wane going into the second half of the year. Now, again, driven by a still solid consumer, when you're talking about fiscal stimulus waning, there's very little expectation that the economy will be able to maintain that very robust 6.5 pace as we saw at the start of the year. And we are looking for a slower pace in a 3 to 4% range in the back half of the year. Again, still positive, but a noticeable reduction from that more robust pace at the start of the year. Now, as we turn the calendar page into 2022, it's very likely that growth slows further to about 2%, bringing us back to that pre-pandemic level of growth. I think it's important to remember that the U.S. economy was already losing momentum before the crisis. We were slowing from a 3% pace in 2018 down to 2% by the end of 2019. So barring the scenario of unlimited government spending and debt creation, again, I don't think it's realistic to expect the U.S. economy to return to a sustainable growth rate much beyond that pre-pandemic level.
Lindsay, thank you. Important clarity there. Lindsay Piegza there of Stifel. Started with a conversation on housing. That data about 6 minutes away. We'll catch up with Michael McKee on that. On the earnings side of things, Netflix after the close. Lisa teeing you up for that a little bit earlier in the program. BN, Bloomberg News, Lisa, putting this one together. $19 billion in value.
Okay, traders, as you can see, position opened for Bitcoin. Short position Well done, guys. Use our strategy. Try to place stop on your profit as soon as it will reach certain level. And then you will move on if it will go even lower. Okay, guys? Well done. Well done. You're in. I'll speak to you later. Let's see what other opportunities. We're still holding quite a few positions on euro against United States dollar, British pound, Japanese yen. So we're busy right now. Okay? Stay safe, guys.
Get that with Prime. What a mess.
Even less of a life than you, John.
What have you got, Tom?
We're just, I got rid of this one, I get rid of that. I canceled one literally yesterday.
I cancelled a couple of newspapers the other day.
They float up in
Shall
the
I share with you who? Yeah. No, I won't do that. Do you know what we need, Lisa? Bundle. Just need to get a bundle, don't we?
I thought we were going to be talking about Squid Games.
Oh,
and honestly, I heard a lot about it. And frankly, it's really a deep commentary on society.
You watch it for us.
Thank you. I will.
I think Scarlett Fu could join us as our celebrity lodestone.
I think that would be very cool. She'd know more than me, Tom.
It's encyclopedic.
Tom Keane, Lisa Bramett and Jonathan Ferro. Housing data, Tom, just around the corner. Mike McKee to break that down. This is Bloomberg.
They don't know what to say. Again, they can't even fathom that they're out of Afghanistan. They're still in a state of shock and can't believe it.
What we have built through this process is essentially a mechanism for getting oppressed women and girls out of Afghanistan. So we're actually going to circle up and see what resources we have left, to see what options we have left, what mechanisms we have left, and actually look at potentially trying to get more women and girls out of the country as well.
We've been through a lot, us, as a team. I know sleepless nights, but you know what? There's nothing more satisfying than knowing that you've saved many lives, and will continue to support these girls on their missions.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
Live from New York City for our audience worldwide, the economic data seconds away. The price action looks a little something like this going into it. Equity futures up 18, advancing 0.4% on the S&P 500. 4 days of gains could become 5. With your economic data, here's Mike McKee.
Well, good morning, John. A weaker start to starts, housing starts in September. Privately owned housing starts at a seasonally adjusted rate of 1.55 million, 1.6% below the August estimate. It is 7.4% above where we were last year at this time, however. Single-family homes about unchanged from the revised August figure of 1.08 million. September rate for multifamily dwellings, 467,000, so a little bit worse as well. Building permits were up by down by 7.7%, and the single-family permits down 0.9%. So September, not a good month for housing overall, although given the problems we have with the potential for higher prices in construction, it's hard to know whether this means that people are backing off because they're afraid of the costs or because they can't afford it.
A price is hurting demand. That was the theme of this quarter, that's for sure. Here's the price action for you. No big changes off the back of this. Equity futures up 19, positive 0.4% on the S&P. The front end of the bond yield curve, that's been pinned for a while this morning. Yields in 3 basis points, a break of 40 to the other side. But the story of the last week, Mike, as you know, in fact, since September 22nd, is that move at the front end. 2-year yields higher, much higher. A ton of Fed speak in the mix this morning. Mike, what do you think the pushback's going to look like this week?
Well, I think the Fed is going to take the same tack it has taken all along and say that we believe this is transitory. It's lasting longer than we expect, but it's not embedded in the economy yet. And we've already seen markets back off a little bit from where they were yesterday, and we'll see if they can talk them back off the ledge.
Mike, there is this question about the Fed's influence over the higher prices, the inflationary push that we've been getting. It's hard to see how they exactly have a role in higher metal prices or oil prices or the price of milk. However, housing is a different story, especially with their mortgage debt purchases. How much has been drawn about Fed's support for housing prices at a time when prices keep climbing and perhaps are climbing too high for many?
Yeah, this is an argument that's been going on for a while. And the Fed isn't specifically targeting housing, that their mortgage bond buying isn't a major reason why we're seeing this. But there's also not much they can do about it. They can't really just target one area. And the general consensus of people in the market seems to be that if they stop the mortgage bond buying, it isn't going to raise rates all that much.
The battle here in the parlor game all centers around a date which is not that far out, November 3rd. I believe that's when Red Sox take the World Series. How critical is your time frame to November 3rd? Give us that nuance of what you're watching and the sweat to the next meeting.
Well, the real issue is going to be what the PCE inflation index comes in at the end of the month, and that'll be right before the Fed
So we
meeting.
get that key data.
Yeah, but the CPI is already out and shows higher inflation, and the Fed doesn't seem to be reacting to that. Most of the data that's going to make a difference to them is already out for the month of October, and they won't have the payrolls report by the time they meet.
Mike, thank you, sir. As always, Michael McKee on some softer data this morning on the housing side of things. A higher price is hurting demand. That's going to be a conversation for later. Fantastic lineup of guests through the last 24 hours. We've caught up with Goldman Sachs' leader, David Solomon, over in London. Also in London, we've caught up with the British Prime Minister, Boris Johnson. John Micklethwaite of Bloomberg News, the editor-in-chief, sitting down with the British leader. Take a listen.
China is a gigantic part of our economic life and will be for a long time, for our lifetimes. That does not mean that we should be naive in the way that we look at our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I've said this many times, it's worth repeating. I am no Sinophobe, very far from it. Do
you think you're the last Sinophile in the cabinet?
No, I expect there are lots of... look, China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at what was you're defining as strategic or critical. But I certainly think that having our trading relationship with China, if you look at it, it's in spite of all the difficulties, in spite of all the sort of angry conversations about or the difficult conversations about the Dalai Lama or Hong Kong or the Uyghurs, and where we will continue to stick to our points, right? We will continue to stick to our views. But actually, trade with China has continued to expand for a very long time, and I think probably will continue to expand, as I say, for the rest of our lives. That doesn't mean that we should be, we should be cautious about how we handle our CNI and about how we handle FDI from China into some of our sensitive industries. And that's why we brought in some of the legislation that we have.
The Prime Minister of the United Kingdom getting to greet those at COP26 in Glasgow. Joining us now, the Editor-in-Chief of Bloomberg News, John Micklethwaite. I put on a new shirt and sat up straight today for this discussion. John, there will be Johnson.
Great improvement.
Thank you. There will be Johnson, there will be Scotland, and there will also be the hope for a future perfect. Your wonderful book of too many years ago, 2003, we need a redo, John. And I want to talk at the back end of that book about the backlash. You mentioned the backlash of globalization. What's going to be the backlash of climate change that the Prime Minister and others face at Glasgow?
I think that's actually quite a good comparison, in fact. I think if you look at the issue in Britain of heat pumps, which is from a green point of view, people are trying to put in much more kind of low energy heat pumps into their houses. And everyone thinks that's wonderful and green, but what's happening is consumers who are generally quite keen on green things are saying, no, God, these are going to cost, it could cost $5,000, they could cost huge amounts of money. And I think that what is happening with greenery is a little bit similar to globalization. Mm-hmm. It's something that everyone generally thinks is a good idea. And remember, there was an era where people thought that generally opening up economies were great and everyone approved of globalization until it happened to them. Everyone approves of fighting climate change until suddenly it means the price of petrol, or gas as you mistakenly call it, rises. That's where it hurts. It's when the heating for your house hurts. It's where things that really affect people particularly. And Johnson is kind of caught in the middle of that, as indeed, you can look at what's happening with the Democrats in Congress.
Do the elites know that at this COP26 they have to sell to a public that's hugely skeptical?
I think, well, one example of the elites is Her Majesty Queen Elizabeth, and she was caught on recorder the other day talking about the fact that nobody was coming and that it all looked very difficult. So I think some people are aware of that, but I think in general, no. I think that it's one of those areas where there is a divide that opens up, and you look around the world, every time it's come up, it's always sort of hit the elites harder. You might remember that example a bit ago where Macron suddenly changed the speed limits on various roads, in part for kind of green reasons, and you suddenly end up with the Gilets jaunes. There's few things that make people more annoyed than something directly hitting part of their pocketbook. You look around parts of America as well, and the debates now about what happens with infrastructure bills and so on. So I think it's a worrying area from the point of view of a kind of global elite view.
Meanwhile, they are hosting COP26 at a time when there's a lot of questions around how much to open your borders. It's been an issue of serious disagreement and, frankly, a lot of consternation. However, at this moment in time, UK's hospitalization and death rate from COVID has actually been going up after being celebrated as one of the big winners from the whole pandemic. How did he respond to that?
Well, it's interesting. You look at the numbers for COVID sufferers, people who've caught COVID, those have been rising very rapidly in Britain. You're right, the hospitalization and death rates have gone up, but so far at least as far as you can see, the sort of vaccine protection thing is sort of holding. The current levels, I think it's around 40,000 a day, people are catching it. You would expect to see many more people dying in the rather gruesome way in which this works. And it doesn't seem to be happening because it's really ripping through, especially young people, everyone who's got schools, people we're working with here, they've got people are stuck at home because their children have suddenly got it. And so there's a degree of that, but there is also the sort of general sense that back to what you said earlier, these things to do with opening up economies, people being there, they are taking, in COVID, Johnson is going a little bit back to his more liberal roots. In that interview, I talk about the fact that we're in Margaret Thatcher's study. There's a picture of her glowering down on us and a copy of Hayek's Road to Serfdom, a key part of the Tom Keane book list, staring down at us. That was the culture from which Boris Johnson came. And he still has some quite strong libertarian instincts at the same time as that he is, by any measure, increasing the size of government fairly formidably. He blames that on COVID. And he's also trying to sort of, I suppose, do a version of industrial policy to push the British economy, especially towards the north, but towards manufacturing, towards things like that.
The football stadiums are full again, John. The important question, sir, were you at Leicester Manchester United last weekend?
No, very, very sadly, I missed that. My life is happy because I saw Brendan Rodgers in a restaurant.
Did you?
None of this will mean anything to people like
Tom knows.
Keane or Lisa.
Like me?
Tom knows, John. You know Tom knows.
I don't.
John, thank you, sir.
Lisa.
Great work as always. John Micklethwaite there, Bloomberg News Editor-in-Chief, sitting down with the Prime Minister in the UK, Tom. What a win for Leicester last weekend, TK. I know you watched that game.
I did. I watched like 3 minutes of it before I got bored, and then I moved on. I only watched
you
it because
got bored of that match?
I only watched it because of Micklethwaite. Come on.
Bored of that game, 4-2.
You know, I watch Aston Villa because of this guy. I watch West Ham because of Steve Major. You know, it's.
I'm just going through the fixture list for this weekend, Tom. United Liverpool on Sunday. We've got a nice, tasty weekend coming up.
Is his job a threat and the coach of the manager of Manchester United?
I think there's this sort of romance of trying to keep the old player at the top of the club, Tom, but it's getting a little bit more difficult. It's getting harder. I knew we'd get to the important stuff eventually, Tom. Tom Keane, Lisa Bramett and Jonathan Ferro on this equity market.
How about those
which keeps delivering.
Harry scored. What do you want?
Did he? Yeah. How about this S&P? Emily Rowland is going to catch up until a little bit later. The CIO, Chief Strategist at John Hancock Investment Management. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. President Biden will continue courting Democratic progressives and moderates today as he seeks to reach a deal to advance his economic agenda before the end of the month. West Virginia Democratic Senator Joe Manchin, whose vote is pivotal in the 50-50 Senate, said yesterday there is little chance that Congress can complete work on Biden's agenda by the end of the month deadline. An elderly couple who broke COVID-19 rules to enjoy China's tourist sites has become the focus of the country's latest virus cluster. Huge contact tracing and testing efforts are now underway after the two retired university lecturers from Shanghai continued to travel even after being told their test results were abnormal. More than 1,500 close contacts have now been identified. Bitcoin continues its climb towards all-time highs, bolstered by optimism over the upcoming launch of the first Bitcoin futures ETF in the US by asset manager ProShares. The largest cryptocurrency has more than doubled this year in volatile trading. The April record is just under $64,870. This is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
So the 1972 Madison Square Garden eyelet jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones, really, for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses, because we have a captive audience. We have people home that really want something to do and need entertainment, so we do our best to try to give it to them.
We're calling for yields to continue to rise here in treasuries, but believe that the Fed rate path, the hiking path, will be relatively shallow, all things considered. The market is trying to figure out whether policymakers will lean against the inflation that we're seeing. Our view is that currently there is too much rate hikes priced in for 2022.
Scott Thiel, BlackRock, very, very good. He's their chief fixed income strategist, holding court there with another good opinion. Right now, we're going to stop the show. Lisa Bramlett and Tom Keenan, we're going to do what we do way too often, and I do this with a major hat tip to anyone really thinking about the retirement industry. A major shout out to the Center for Retirement Research at Boston College, which has done brilliant work over the years on America's failed retirement system. Also, one Barry Ritholtz has done great work on saying, hey, wait a minute, here's the reality. We're thrilled that Birthday Boy could join us this morning, as he is 1 year closer to retirement here in a few days as well. Barry, let's start with Rule 101. I need to be 60-40 and have a carefully balanced portfolio. That's been thrown out the window. So what do I do to get to retirement if you've got the gray hair that you and I have?
Yeah, I'm not quite 60. My birthday is still a few days off in the future. And Lisa's not quite 40, so that 60-40 is, we're not there yet.
Hold up.
So you have three options that you can do if you're looking to get more returns. First, your 60-40 becomes 70-30, given how low rates are. That's when people talk about TINA, there's no alternative. That means there's really no alternative to equities if you're a bond investor. Second, you have to consider alternatives themselves, and that's everything from structured notes to farmland to you name it. You have to look beyond traditional municipal bonds that are only yielding an after-tax return of, depending on the state,
Lisa's long copper.
And then the third thing you have to do, which I really don't care for, is go out on the risk curve, go out on the duration curve, use leverage, do all sorts of tricks, which if you paid attention in 08, 09, you really don't want to do, but that's a third option, and that's starting to creep into more portfolios. I am not a fan of that third choice.
Barry, how much of moving to a 70-30 is that stocks are just better than bonds when it comes to potential returns there, versus bonds no longer offering the ballast the way that they have in the past, that they will not necessarily gain in a risk-off environment?
So let me push back a little bit on that. Bonds are still a ballast. If stocks fall, look, we've been within 5% of all-time highs for quite a run here. It's almost a year. When we get a 25% drop, a 30% drop, I'm pretty confident that bonds will rise, but their main purpose in a portfolio is to not fall and to issue yield. It's that second aspect, the coupon on bonds, that's problematic. They'll still offer some ballast. As to 70-30, I could give you a couple of rationalizations. The best is probably, for the most part, the investor class lifespans have extended. It's not unthinkable that a lot of people who are pretty well invested in the market are going to live far beyond 72, 80, 85, 90 year olds are pretty, and hence, you know, in the old days, you would go 60-40 to 50-50 when someone was 60, 65.
Yeah.
That's not taking place now. People are engaging in a higher risk exposure for longer with the expectation that I need to do this if I don't want to outlive my money.
So in the olden days, people also cared a lot more about the Dow Jones Industrial Index. The idea here that some of the old behemoths were the powerhouses of an economy that has much changed and a market that reflects that. And I do wonder about some of the leaders today, Netflix being a prime example, about to report earnings after the bell today, having grown dramatically, shares up almost 100% year to date with a lot of dynamism. What's the risk of technological disruption to a market that hinges so much on the prowess of some of these giants?
Well, start out with recognizing that Netflix was the technological disruptor. They went from DVDs by mail to streaming, and now they're just over 50% of the market. Add everybody else, Disney Plus, Apple, Hulu, go down the whole list, Amazon Prime, add them all together, they're still not as big as Netflix. So eventually, Netflix is going to have to give up some market share. It's just a matter of time. There's no way around that. But that said, I don't know what the next disruption is going to be to streaming. Netflix may or may not be in it. When we look at who are the 10 largest companies by market cap in the S&P 500, look at it on a 5-year basis. And I threw this chart up on the blog last week. You could see that changes pretty dramatically. 20, 30 years ago, it was dominated by oil companies. Today, 6 or even 7, if we want to say Visa is technically not a pure financial, but a technology company, they're all tech companies. It's Apple, Amazon, Google, Facebook, NVIDIA. You go down that list, tech is what dominates these, not oil, not energy, not even consumers. It's quite amazing.
Yeah, I got to leave it there. We're out of time. I got 18 more questions on actually what we do with our money and the plan forward. Mr. Ritholtz, of course, writing for Bloomberg Opinion with a terrific podcast that garners thousands and thousands of listeners each week. Lisa, it's an absolutely unusual time. And what I find just stunning, besides the simplicity that the Gloom Crew has been humbled, is that we've seen it dovetail with a commodity lift. I didn't expect that.
Right now, I'm trying to get my head around this idea of what's driving the inflationary push that we're seeing. How much is demand-driven? The fact that people have so much cash in their savings accounts, and how much is the supply chain disruptions? The idea that we're seeing just people not getting back into the workforce after the pandemic, and this, to me, is a determining factor with transitory or not. And I'm struggling to understand how to even look at a market that looks vastly different than the one that we saw 10 years ago.
So we mentioned earlier, we make some jokes about it, $19 class. I don't even know what Apple's doing there. But the bottom line here, Lisa, as Barry mentioned, is there's this technology overlay over everything we do. And am I right that those winners will go out and issue debt like it's almost a layup? That they will announce mega gajillion debt offerings because they hold the high ground.
And what are they going to do with the money? They don't have a lot of employees, a lot of them. It depends which tech giant we're talking about, right? And Amazon does something very different than an Apple, but they buy back their shares. And this goes to the question of where does the potential growth go going forward? And I will ask this, Tom, are those tech giants and the advancements there, Is that inflationary or disinflationary going forward?
I don't know. I've got Amazon off the Bloomberg, and folks, this is a great function. WACC, weighted average cost of capital. They've got debt of 6.6%, so they've got ample ample ability to move out to something else.
I'm sure that they can sell it at a lot cheaper than that right now. Right now, though, I do find it fascinating that as everybody talks about stocks and the dynamism there, if everyone goes back to bonds the second there's any problem, yields remain low, and then it's right back into stocks. It's this cycle, virtuous cycle.
Futures up 18. The VIX stunning. We had a 15 handle earlier, right? 16.06. Please stay with us through the day on Bloomberg Radio and Bloomberg Television. Good morning.
OECD nations need to end coal use by 2030, developing nations need to follow suit by 2040, and we need coalitions of solidarity between countries that still depend heavily on coal and countries that have the financial and technical resources to support transitions, because it is essential that no more coal power plants are built.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Within 1% of all-time highs from New York City for our audience worldwide. Good morning, good morning. Equity futures with a lift after 4 days of gains on the S&P. We advance a third of 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue, looking for earnings to counter inflation concerns.
There's a lot of talk at the moment around inflation.
The inflation concerns right now are really from the supply side.
The earnings story has overpowered that.
We've not really seen a huge impact from the supply chain disruptions.
Earnings was going to be a catalyst to get the markets to recover.
Look at the earnings story for the S&P 500.
Outright inflation should dissipate.
Frankly, we still think that has legs.
It really blew everybody's expectations out of the water.
Corporate earnings are going to be fine.
Our company is going to be forced to eat these increases in cost.
Corporate revenue is going to be fine.
The supply chain issues.
It's really yet to squeeze margins or really have any negative effect on earnings.
The results that we had so far is that margins are still pretty resilient.
Is it a case of so far so good? With us, Nuveen's Tony Rodriguez, John Hancock's Emily Rowland, and Barry Knapp of Ironside Partners. Let's begin with you, Emily. Is it a case of so far so good this earnings season?
Yeah, absolutely. So far, we're about 10% through the season, and year-over-year earnings growth is coming in at over 40%. That's versus 26% expectations at the beginning of the quarter. Of course, mostly that's been the big banks, and we've seen them benefit from stronger loan growth, from the release of loan loss reserves, reflecting optimism from the banks. But, you know, it's just the start here. We've got the majority of S&P market cap coming in next week with the big tech names. So still a lot to be learned here. What we're looking at is for companies who have an advantage in this higher inflationary backdrop. And to us, you've got to remember that company earnings, they're nominal. So when prices go up, a lot of companies simply have the ability to make more money, particularly the ones that have high operating leverage. So companies with fixed costs, it doesn't cost them any more money to make that product, which is now being sold at a higher price. We see areas like industrials being a huge beneficiary of that, and we'll have to see how that plays out in the weeks to come.
You mentioned industrials. Let's pick up on that. Barry Knapp, you don't share that view on the industrials.
No, actually, I think Emily's onto something. Industrial sector margins of all of the major sectors probably have the most to go to get back to prior peak. And you know, if I had to break down the call of marginal cost versus marginal revenue, we can call that the Mike Wilson argument, or fixed cost versus operating leverage, which is more the Jonathan Golub argument. You could tell I was an equity strategist once, so I follow these guys. But I still think that operating leverage is probably a bigger factor. There'll be plenty of cases of companies that ran into that marginal cost versus marginal revenue, and it'll be difficult to tell, you know, whether some top line misses are a function of whether demand is weakened, whether there's been demand destruction. I don't think there really has, or whether it's just, you know, still supply related issues. But yeah, the industrial sector still has room to run on that operating leverage front. So
Barry, I'm just picking up on your notes.
Some upside there.
You say we recommend reduce risk in equities in small caps, emerging markets, materials and industrials, maintain exposure to reflation and financials and energy. Is that wrong then, Barry?
That's been our stance all the way into this, and net revisions are still falling. But the bigger issues there are the tech companies and the consumer staples companies that are really going to press those earnings revisions down. Industrials, we reduced risk, but we were way overweight in that sector. So we're at market weight at this point.
Got it. Thanks for the clarity. Thank you, Barry. Tony Rodriguez, do you share this more constructive view on risk assets into next year?
Well, good morning, Jonathan. Good to be with you. And yeah, we do share the constructive view. I mean, we are not expecting kind of further upside, for example, in credit spreads and further tightening. You know, valuations are pretty full from our perspective. But we do think that we'll be fairly range bound on spreads, and then therefore that's a risk premium that an investor can earn. Some good points were made about a strong earnings season. We do think that corporate America is able to kind of manage through this period of supply chain pressures, whether it's through finding cost savings or if they're able to, you know, take that increased revenue and maybe reduce their margins slightly. We still think that at the end of the day, that leaves the credit health of corporate America in very good shape. We've seen credit metrics already kind of improve back to pre-COVID levels. So we think liquidity is high for company balance sheets, and we think credit quality is high in the financial sector. So overall, that's a pretty good picture for credit risk assets.
Well, let's build on that corporate guidance we're getting. This from the Danone CFO, expecting inflationary pressures to worsen. This is what he said earlier on. Quote, "We expect 22 at least at the same level as 21 and maybe even higher," going on to say we need to get prepared for more supply chain disruptions and challenges. That's the message from Danone. Kaylee Lyons has more. Hey, Kaylee.
Hey, John. Well, it's not just a message we're getting from European companies. We're getting it from U.S. companies as well, because, of course, we've gotten a number of earnings reports out over the course of the morning, and it's been a bit of a mixed bag. On the one hand, you have the likes of Johnson & Johnson actually gaining because it was able to lift its profit outlook. But for other companies like Philip Morris or Procter & Gamble, the supply chain issues are really evident. For Philip Morris, they say that they can't make their heated tobacco products at enough scale because it's being crimped by the global chip shortage. And P&G expects $2.3 billion in after-tax expenses because of elevated commodity and freight prices. So that echoes what we heard not just from Danone, but also Ericsson earlier today, which warned that supply chain issues could persist for even longer. It's part of what's becoming a deafening chorus of similar warnings. The phrase supply chain has already been used more than 3,000 times on conference calls from 2021 thus far, and the third quarter reporting season really is just getting underway, so that number could go a lot higher. All of that said, though, John, when you take a look at the reports we've gotten from S&P 500 companies so far, they're still beating, and to a larger extent when it comes to the bottom line. Earnings surprising on average to the upside by about 13%, while on the sales side, they're only surprising to the upside by about 2%. And that could point to a number of things. The bar could have been higher for revenue because demand was never the problem, but also if profits are still surprising to the upside, that shows an ability of companies to pass on higher input costs and retain margin, John.
Kelly, thank you. Let's talk about how some investors are thinking about some of these issues. This was in a fund manager survey from Bank of America this morning. This was the quote that jumped out. It was right at the top of the piece they released. Least bullish fund manager survey since October 2020. Cash has jumped to 12-month highs. Growth expectations are negative for the first time since April of last year on inflation and on China. Now, Emily, I know you've been digging through this as well. It's interesting, isn't it, to see the least bullish fund manager survey in about a year and an equity market within 1% of all-time highs. Can you make sense of that for us?
Yeah, John, I think we're sort of throwing out the old playbook right now as some of the developments in the market are so unusual. Now, normally, if you think about, being bearish generally speaking, that would be an environment in which you would want to own bonds. That's what all of our work has told us in this industry. And right now that's being flipped on its head because, of course, investors are concerned about inflation, which is the enemy of bonds. So we agree that equities are going to need to do a little bit more of the heavy lifting here, but we also believe that all of these inflationary and supply chain pressures, dare I say the word, are transitory. Remember, the events that got us here are a once-in-a-lifetime thing, in our view. We shut down the entire global economy. Manufacturers sold all of their inventory. They fired all their workers. Now they're all trying to bring things back online at the same time. Meanwhile, you throw, $10 trillion of fiscal stimulus on top of it, increasing demand, and then you've got this sort of perfect storm of inflationary pressures on top of, disincentivizing people to return to work. So we think these problems really resolve themselves. We think inflationary pressures ultimately subside. We're not as concerned about owning bonds. Yes, right now we might see a backup in yields over the intermediate term, but we actually expect these cross-asset dynamics to start to reassert themselves and as things return to normal in 2022.
Looking forward to catching up with David James of Bank of America a little bit later this morning, 9:30 Eastern. We'll catch up with him in about 20 minutes' time. Let's talk about this one, Barry. There seems to be a spread, a difference between what people say and what they're actually doing right now. It sounds very bearish, but the equity market within 1% of record highs, Barry.
Yeah, that's one of my old approaches to the sentiment. Whole sentiment discussion is what they pay rather than what they say, and what they pay generally can be reflected pretty well in derivatives prices. We never really did get the VIX futures curve to invert. That is the 1 month future to go above the 6 month future, for example. You never got the VIX anywhere near 30, so you didn't really get the fat pitch to re-enter the market. Sentiment's deteriorated somewhat, but not to the point where you would typically expect when the Fed's starting to normalize policy. We're faced with higher corporate taxes. That was at the core of my expectations of a 10 to 12% correction. And the idea that you would get this, sentiment, real sentiment negative signal, but we just didn't get it, or we haven't gotten it at least.
There's some odd kinks in this survey. I'm looking forward to catching up with BofA about it in about 20 minutes. Tony, the bond allocation story, Emily just touched on it there. Within this survey, allocation to bonds is at a record low. Allocation to bonds at a record low as people are getting more and more bearish. I guess what it depends on, Tony, and Emily also mentioned this, is what they're bearish about. If it's inflation, do I get the protection I want from where I typically get protection from? And maybe, Tony, the answer to that is no.
Well, I think you're right on that one, Jonathan. I think investors do need to look beyond kind of maybe traditional ways that fixed income fit into a portfolio. So our view is that if you look at just the kind of high quality segment of fixed income where you have, globally negative yields, and in the U.S. certainly, significantly negative real yields, there you're not going to find what you're looking for. I think what you need to do is look beyond that segment of the market, look at higher spread, higher yielding assets in a pretty diversified fashion, because we do think that credit health is going to be pretty good. I mean, the market is clearly climbing the wall of worry. There's plenty of concerns out there. So surveys might tell you that there's quite a bit of concern. But when you look at where flows are, what investors are actually doing, you're seeing tremendous amount of money continue to come into the financial markets, whether that's on the equity side, on the private asset side, or in liquid fixed income assets on the credit risk side. So I do think you want to follow what investors are doing more than what they're necessarily saying.
Tony, sticking with us, Tony Rodriguez, alongside Barry Knapp and Emily Rowland. Coming up on this program, a growing chorus sounding the alarm about a potential policy mistake.
The Fed needs to redefine what they think of as an acceptable employment level, or they're going to stay too loose too long.
Is the Fed at risk of staying too loose too long? That conversation up next. From New York City this morning, good morning. 20 minutes away from the opening bell at 15. We advance 1/3% after 4 days of gains on the S&P 500. Within striking distance, we are staring down the barrel of all-time highs. This is Bloomberg.
When you look at technology, how should we be looking at big banks and technology?
Technology is our friend. So it's helping us transform the bank fundamentally. And in fact, we're speaking, I think, as we speak, to our shareholders around what we've done and how we've transformed the bank. We also see technology, and technology companies as partners. So some
not
of our
rivals.
We know that there are big parts of what have been our business historically that will be absorbed into convenience platforms. And by convenience platforms, whether that's Amazon or Facebook or Alibaba or Tencent or something like that, those are platforms that are just very convenient for people to conduct their day-to-day financial affairs. And it'd be very difficult for a bank to compete with that. Now, in some cases, I'd say, let's say in Africa, we are setting up a competing platform to the convenience platforms. And we're working with technology companies and mobile telephony companies and others to create a platform of our own. But for the most part, we're going to be playing on somebody else's platform.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The Fed needs to redefine what they think of as an acceptable employment level, or they're going to stay too loose too long.
The central banks are now running the markets.
Anytime the Fed kind of whispers that they're going to tighten,
You see the wall of worry increase and, the markets trade off.
They may make a policy mistake here by waiting too long.
The question is whether the economy in the West can function without the central bank being ever present. And I think the answer is we don't know.
We don't know. A growing chorus of investors sounded the alarm about a potential policy mistake. Deutsche Bank hoping the week ahead provides some clarity. They say the following. Though this week's economic calendar will provide fresh information on the state of the manufacturing and housing sectors, market participants will have to contend with a full Fed-speaking docket, including appearances from Chair Powell. For more on this, let's bring in Mike McKee. Morning, Mike.
Good morning, John. Well, John Authors puts it well in his Bloomberg column today. Suppose inflation is not transitory. It is here for a while. What then do markets and central banks do? Well, it comes down to this. Which is a worse policy mistake? Waiting too long and letting inflation get entrenched, or tightening too soon and sending the economy back into recession? Emerging markets, in many cases, are taking the latter view and starting to raise interest rates. And you can see how they have moved up in many markets compared to the United States. But the U.S. big guys, the ECB and the Bank of Japan holding off because they're looking at this. Consumer prices, which jumped after the great financial crisis, then fell back way down to nearly below zero. Now they're up again. So do they bet on a reversion to the mean? Well, if you think inflation dynamics haven't changed, you would make that bet. And that's what investors seem to be doing. You can see here the market expectations over 5 and 10 years are higher, about where they were when the post-great financial crisis came along, and yet they have not traced current inflation all the way up. For all the angst and inflation commentary, money remains relaxed, John.
This rates market, though, Mike, this is a direct challenge to the communication of this Federal Reserve, is it not?
Well, it isn't really yet. I mean, when you look at where they are compared to where they were coming out of the great financial crisis, there's a big difference. They're up a little bit, but they're not up a lot yet, and they've started to come back a bit down. We'll see how it traces out over the next 2 weeks.
Mike McKee, thank you. Ton of Fed speak today and through the week. Back with us, I'm pleased to say, it's Barry Knapp, Emily Rowland, Tony Rodriguez. Emily, you think the Fed could be forced into a policy mistake here. What do you mean by that?
So the reflation trade is awakening from the dead. Maybe I've got Halloween on the mind too much right now, but that is really coming at a terrible time. And we think that speculative behavior is fueling this increase in commodity prices, whether it's, lumber, whether it's oil, you name it, copper prices. And really that is forcing the Fed's hand in a way that potentially they're going to need to deal with higher inflation and potentially risk raising rates or tightening policy at sooner than we had expected. And that could create a lot of pressures across the economy as tighter financial conditions might be coming at a bad time when things like gas prices are going higher. We've got to remember here that monetary policy is not equipped to deal with these supply side problems. Monetary policy is not going to help bring these ships back into ports. It's not going to help unwind these supply chain problems. So in our view, the Fed right now is really stuck between a rock and a hard place.
Tony, what's your take on this?
Well, Jonathan, I think the Fed has made it pretty clear that they're more worried about unemployment than they are about reacting quickly to inflation. They feel the bigger mistake would be to react early, and that they're going to be patient with current inflationary pressures. We think that from the supply pressure standpoint, we would expect to see by the middle of next year that beginning to ease, and we'll see some moderation in inflation. But we think the key metric for investors to look at is really the labor force participation rate amongst the working age population. That's where the Fed believes there's some slack, that there will be people re-entering the labor force in response to either higher wages or school reopenings and COVID relief. And if that doesn't take place, then you do run a pretty serious risk that wage pressures begin to grow and accelerate, and you get the classic wage price spiral, which then the Fed would have to respond to pretty aggressively.
So, Tony, the big bet is whether the participation rate recovers or not. Is that right?
That's exactly right. If people can come back into the labor force, that'll keep a little bit of a lid on wage pressures. We think the supply chain pressures will kind of ease as both demand comes off as we move into next year and as companies obviously reorient their supply chains and catch up with the very, very large amount of orders and demand that they are seeing.
That's the hope right now, the hope that those things develop through next year and things get better. Barry Knapp, right now, though, there is a direct challenge. To counter what Mike McKee said, the Federal Reserve has told us there's a difference between tapering and raising interest rates, and a signal on one is not a signal on the other. But this market has doubled the 2-year rate in around about a month. Isn't that a challenge to this Fed?
It is, and I disagree largely with what's been said on this topic. We had disinflation for a couple of decades because of a global labor supply shock. It was the integration of China and the Soviet bloc into global supply chains that put downward pressure on manufacturing wages. We lost 5 million manufacturing jobs. All of the disinflation came through goods prices. Services prices have been running better than 3% all along. We are going to restructure global supply chains. Yes, the supply chains will clear, but when we settle back into trend inflation, we're going to have significantly higher goods inflation. We've already changed the labor share of income dynamic. It's rebounding sharply. It's going to continue higher. Wages are headed up. So the whole inflation process Chair Powell has talked about was underway beginning in 2018, and the pandemic just accelerated it. So when we get to the other side of this, yes, inflation will be lower next year than it is this year, but trend inflation is going to be well above Fed's target. Wages are headed up, and the Fed is going to find themselves in a spot. Now, you've moved that, as you note, expectations of potentially 2 rate hikes into next year. It'd be hard to move much more than that because of them not wanting to go before they end the taper process. But the Fed's already made a mistake. They spurred demand in the most interest-sensitive parts of the economy when they were supply constrained. So the mistake is that they were too easy already, and they will definitely be behind the curve this cycle, no question. We've moved from disinflation to reflation, and that's going to be the trend for the next few years.
Emily, given the slightly scarier world that Barry describes, is that a world where you want to own equities still?
You know, we do. And as I mentioned before, we think equities should do more of the heavy lifting here. And what we look at are next 12-month earnings estimates, which continue to move higher, particularly in the U.S. We also look at an economic cycle. Yes, we've talked about this deceleration away from peak growth and peak accommodation. But look, the U.S. economy is still running on all cylinders here. So you've got positive economic growth. You've got positive earnings revisions. You want to continue to embrace equities in this market, but you've got to be careful about what you own underneath the hood. This is the time to move to really fade that reflation trade and move more into the quality part of the market. We want to own stocks and sectors that have great balance sheets, good return on equity, ability to maintain margins as the economic climate cools, and that leads us to quality, in particular large cap growth in the U.S.
Let's build on that around the opening bell. Emily Ronan there, sticking with us alongside Barry Knapp and Tony Rodriguez. Coming up, the morning calls, and later, everything you hear on this show, pretty much countered by what you hear in the Fund Manager Survey from Bank of America. That one sounds very bearish. We'll catch up with them in about 7 minutes' time. From New York, this is Bloomberg.
crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
5 minutes away from the opening bell this morning. Good morning. Let's get straight to it. Equity futures up about 1/3 of 1%. Here are the morning calls. We start with Wedbush downgrading Zillow to neutral. The analysts seeing a number of uncertainties clouding the outlook heading into next year. Evercore downgrading Marriott to in line with a 160 price target, highlighting the stock's rich valuation after outperforming over the past month. And finally, D.A. Davidson raising its Apple price target up to 175, expecting COVID to fuel an upside earnings surprise with consumers buying more laptops and tablets. That stock back up to, let's call it 147, up 1/4%. Coming up, the widening disconnect between souring sentiment and the performance of this equity market. We catch up with Bank of America's David Jones on their latest fund manager survey. That's next. This is Bloomberg.
Madison Square Garden eyelet jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones, really, for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses, because we have a captive audience. We have people home that really want something to do and need entertainment. So we do our best to try to give it to them.
Do you consider yourself a filmmaker, a historian, an educator?
Well, you know, the biggest thing is that I'm a filmmaker, and that means I tell stories. And the way a painter might choose to work in oil as opposed to watercolors, I choose to work in history.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
4 days of gains could become 5 on the S&P 500. So far, the longest winning streak going back to August, and we're set to add some weight to it. Up about 17 points on the S&P. We advanced 0.4% on a NASDAQ. Up about 1/3 of 1% on the Russell. We're doing okay. Up 0.4%. That's the opening bow. Switch up the board and get to the bond market. The shape of things as follows. A ton of Fed speak. The focus not on 10s, but on 2s. On 10s right now, 160.73 yields higher by about a basis point. On 2s, because we're bringing in that rate hike conversation. We fade that just a little bit today. And as we fade that story just a little bit today, we fade the dollar strength story. Euro stronger, euro dollar 116.45. Crude back to 82. It was positive earlier in the session, now negative 0.4%, 82.13 on WTI. So we open things up this Tuesday morning, about 25 seconds in, positive by 1/3% on the S&P. Early days, consumer staples are flat. Utilities advance about 0.6%. Industrials, a topic of conversation on this show, middle of the pack, advancing about 0.5%. The Bank of America Fund Manager Survey, that's a big topic of conversation as well. Here's the quote, the takeaway. The least bullish report in a year, showing fund managers quickly souring on global growth and earnings, yet remaining pro-risk as they slash bond holdings and buy U.S. equities. Here's Bloomberg's Katie Lyons with more. Hey, Kaylee.
Hey, John. Well, Bank of America describes this as the bulls going into lockdown. And to get into some of the details, global growth expectations actually went negative for the first time since April 2020, which was, of course, the height of the pandemic fear. You also have things like margin expectations going down to the lowest since May of last year, and predictions of stagflation were up to 34%. You also see a pulling forward of Fed hike expectations, the first one now seen as November of 2022. What's interesting as to how this has or has not translated into asset allocation. On the one hand, cash levels jumped to a 12-month high. Bond allocation hit an all-time low at negative 80%, but stock allocation held steady at 50%. So there remains a disconnect between growth pessimism and the persistent desire to hold risk in a portfolio. Within stocks, banks the #1 global sector, while Europe is the #1 region for equities. As for the most crowded trade, it's a very familiar list. Once again, long tech is at the top, followed by long ESG, and then short China and EM and long Bitcoin coming in at spots 3 and 4. But there are some interesting changes to the greatest tail risks investors see, John. Inflation still comes in at #1. That remains the same. But China risk has now popped up into second place. And fears around the Fed taper have now moved down to spot #4 after asset bubbles. And COVID-19 fear, John, has dropped all the way down to 5th place.
Kelly Lyons, thank you. Replaced by a very different story now. Slightly connected to it as we try and reopen this economy. We're still trying to reopen this economy and get things back to normal. I have no idea what normal is anymore. That's a rant for another time. Joining us now, I'm pleased to say, what a great lineup we've got this morning. David Jones joins it from Bank of America. David, thank you for being with us, sir. What a fascinating read this research was this morning. To see your survey, the least bullish since October 20, at a time where we're really close to all-time highs, David. What do you make of that?
It is interesting, and we were very careful in calling it least bullish rather than bearish, because the macro story has obviously changed very much for the worse, but the positioning story has changed less so. So as you mentioned at the top of the segment, what we've seen is that now investors are expecting a net 5% are expecting global growth to weaken over the next 12 months. They're expecting profits to weaken as well. I think 15%, and that 15% said that. And margins are also, 51% say that margins are going to compress. And the driver for all of this really very much is inflation.
So David, I'm trying to understand if I lean the other way, and then I'm trying to second guess myself and understand what leaning the other way actually means. The cash allocation has jumped to a 12-month high. Typically, I'd see that and say, okay, let's be a contrarian here and lean the other way. But now I'm wondering whether what people say is not what they're doing, David. How do you read this one?
Well, I think that the survey has been pretty reflective of where the market has been over time. We now have a record 430 respondents and 1.2 trillion who manage 1.2 trillion in assets. So it's a very good reflection of where the market is. I think what is probably one of the big takeaways for me from the survey is the capitulation in bond holdings.
Yep.
The net overweight at an all-time, net underweight at an all-time high. And that is what saw investors go into cash. They were taking money out of bonds and into cash.
The record low bond allocation, what would you be doing here then, David? At the end of this piece of research, you guys put out the survey, and then you put the contrarian themes out there for all to see. Any of them take your fancy right now? You talk about a rate shock, South Tech, a growth shock, long bonds, short banks, Goldilocks, long EM, industrials, and short the dollar. Which theme do you want to pick up on right now, David, with everything you've just said?
Well, we've been very much in the camp that inflation is going to surprise to the upside, and it's going to be more persistent and more sticky. And we think that growth is going to surprise to the downside. So in that environment, if you do believe that there is a rate shock, as you say, you want to shorten up on the U.S., particularly technology, which doesn't do so well when rates rise. If you are in the camp that you believe that growth is going to surprise to the downside as well, or that there's going to be this downside growth shock, then yes, you probably want to start looking at staples and utilities. We believe that those are actually a very good macro hedge, and we've been urging people to add that to a barbell.
David, great to catch up with you, sir. I know you're busy this morning off the back of this, but we appreciate your time. David Jones there of Bank of America.
Always a pleasure.
Thank you, sir. Thank you very much. Back with us, I'm pleased to say, Tony Rodriguez, Emily Rowland, Barry Knapp. Emily, you picked up on the same story, the bond allocation piece of this, and I don't know what to do with it. What do you want to do with it?
Look, we still want to own high quality bonds in a portfolio, but we are underweight. We want bonds that are going to act like bonds. If we do finally get this period of volatility, we haven't seen it yet, but it's likely to come here in this cycle, but you've got to do more. And Mike McKee mentioned this earlier, rates are very low by historical measures. The Fed usually doesn't start hiking when rates are this low. So you've got to look elsewhere in fixed income. Tony touched on this as well. In particular, we're honing in on the BBB part of the corporate bond market. We're looking for some additional yield in the BB space within high yield bonds. We don't want to go too far down the credit spectrum there and reaching too far for risk. And we also want to focus on benefiting from roll down. The intermediate to the short end of the curve is actually still quite steep. So we think investors can generate somewhere between 2 and 4% in yield with a duration a little bit lower than the benchmark. And, you know, I know that doesn't sound all that exciting, but every little bit of yield counts with that combination of high quality bonds and then looking in the credit markets for some additional income as the economy continues to improve.
Barry, let's keep building on this. The potential for a rate shock. Given everything you've said, Barry, in the last 30, 40 minutes, do you share that view?
So I want to broaden this out just a little bit. What the situation that I'm describing, or the scenario, the regime that I'm talking about moving into, a reflationary regime, has pretty good precedence. And this is very much what happened in the early 1960s, where we had accommodative fiscal and monetary policy, faster nominal growth, faster earnings growth, negative returns for bonds, which built over time, and growing inflation. But we didn't go straight from the 50s to the 70s. We had this reflationary regime. So I would definitely be underweight fixed income. I would be overweight equities, but in the reflationary sectors, because I do think that this trend is going to persist for the next couple of years. And so in that environment, Emily's tactical approach to bonds makes sense for sure, because credit's going to be fine through all this. Tony said similar things, but I would definitely continue to be underweight bonds and not underweight the bond proxies within, or overweight the bond proxies within equities, be long those reflationary sectors.
This is something Emily said earlier on in the show, and I think it's worth repeating, Emily, that when you're worried about inflation, own equities, not bonds. That makes sense. But in a world where you're worried about inflation turning into a rate shock, do you want to own an equity benchmark that is overweight tech? Emily, help me out there.
The reason you want to continue to own an equity benchmark that's overweight tech is because we are moving into the middle part of the cycle here. We're moving away from the early cycle where Fed policy is ultra accommodative, where earnings growth is surging, and we're moving into an environment where things are going to get a lot more difficult. You want to own quality growth. These are companies that can navigate this environment. They can grow earnings even as the economy starts to slow. So we want to pair that here with value. We still want to own some value here. Don't get me wrong. We want sensitivity to this new cycle that's unfolding, to these inflationary pressures that are building for now, but we want to do it thoughtfully, again, in areas like industrials and away from those really highly reflationary sectors that we've talked about earlier. Fade that and move into a combination of value and quality growth.
This has just been so hard to navigate for so many people. Morgan Stanley came out with this quote over the weekend. I've repeated it a few times this morning. I think it's worth doing it again. Year to date, 88% of S&P 500 companies have had a 10% drawdown, a 10% correction, and the index has only delivered a 5% drawdown. This is not your world, Tony. Your world's fixed income, but I think it speaks to a world that is just increasingly difficult to call. I talked about the data we've had in the past week on consumer sentiment, the weakest, second weakest reading we've had since 2011. At the same time, the quits rate is at a record high. Tony, there continues to be something in there for everyone. And all year I've asked every now and again a question, a simple one. When do we start to resolve some of these issues and get a cleaner read on this economy? And Tony, it seems like it's not Q4. It's somewhere, hopefully, in 22. Is it in 22?
Well, Jonathan, you make a good point. There has been a lot of conflicting information. There's something for everybody, the bears, the bulls, et cetera. If you'd asked me back in March, I would have said that by the fourth quarter, we would see some resolution, some more clarity. That's clearly been pushed out both by COVID and the persistence on the supply chain pressures. We're expecting that by mid-next year, you'll begin to get a much cleaner read and a much cleaner picture. We certainly support an overweight to equities here at Nuveen, but we also think that there's plenty of very attractive opportunities in the fixed income space, as I mentioned earlier and Emily highlighted as well. The one message I think that does come out of that BofA survey, though, is that investors, I think, need to make sure they have the return expectations set far lower than what we've seen this year. So whether that's the margin pressure the survey talks about, some moderation in growth, what it really says is that you're not going to see high double-digit, high teens returns out of the equity market next year. And in that environment, kind of that mid-single-digit return out of some spread sectors out of fixed income with much lower volatility is a pretty attractive combination.
I have to say, and Tony, this is not a criticism. I've just heard that a few times. I heard that last year, and Emily, we're up 20% on the S&P 500 year to date. I understand Tony's talking about the credit side of things. That's a very different story. But on the equity side of things, we were bullish coming into this year, and Emily, we weren't bullish enough.
That's absolutely right. And by the way, normally it takes about 5 years into a new bull market to earn what we've just earned in the last 18 months. So we have not seen the volatility. The biggest drawdown we got was 5%, and every investor out there just scooped it right up. And I think it's a classic case of FOMO, or fear of missing out, where investors are reaching for returns in equities. And I completely agree that this is the time to do that gut check. Make sure you understand how much volatility you can handle. Again, we still think equities are the best, most attractive opportunity out there as far as the global markets go. We think it's far too early to get defensive. We agree that you don't want to own those defensive bond proxy trades yet. Now is the time to position carefully for this mid-cycle environment, which frankly may persist for a while, but it's likely to come with a lot more bumps along the road than what we've seen over the last 18 months as that $10 trillion in fiscal stimulus and monetary policy accommodation starts to fade into the background.
Emily, great work as always. It's good to hear from you. Emily Roden there, alongside Tony Rodriguez and Barry Knapp. Your equity market positive 0.4% on the S&P. Bit of news around the Bitcoin story. Let's get to it. Here's Abby.
Indeed, John. It's being called a watershed moment. We do have the ProShares Bitcoin Futures ETF trading. In the first few minutes, it's pretty volatile. Now, the ticker is BITO. It started off a little bit lower, was up as much as 3%. Now it's up just 0.5%. It had almost gone negative. Also interesting, John, is the fact that Bitcoin itself up about 1.9%. This ETF currently up 0.5%, so a pretty big divergence. The true mark of success, though, could be the assets that come under management over time. GLD, in its first 3 days, took in $1 billion. Let's see what happens with BITO. But currently, this Bitcoin ETF up 0.5%, well off of its highs, and not up as much as Bitcoin itself, up 1.8%.
Abby, thank you. Coming up on this program, just days after going toe-to-toe, are we making some progress down in D.C.?
We're talking. All right, we're talking.
You're going to have a resolution by the end of the week, it sounds like?
We're talking. We're going to make some progress.
We're talking. Did you get that? We're talking. The latest on President Biden's spending package next. This is Bloomberg.
Such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
there's always a balance between the free speech and being responsible and taking down content that we think could lead to some kind of real-world harm.
What we can diagnose, so it's more about peace of mind and determining whether they do need to be seen in person.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
He will host two different meetings with House members here at the White House, one with moderates and one with progressive members. We are at a point where we feel an urgency to move things forward, and the pickup of meetings is a reflection of that.
President Biden planning to meet with divided Democrats, hoping to reach a deal before month's end. Senator Joe Manchin sounding a bit more optimistic, telling Bloomberg the following: "There's an awful lot to go. I don't know what would happen. Once you come to a meeting of the minds, you might be able to work something out." For more, let's catch up with our Washington correspondent, Bloomberg's Anne-Marie Horton. Morning, Anne-Marie.
Good morning, John. That meeting of the minds, that is still what these two different spheres of the Democratic Party are trying to get through. And the president today is going to try to be the one to bridge that division. So first he's going to be meeting with House progressives, and then later in the afternoon, bicameral meeting, so with House and senators that are moderate. And what he's trying to do is get to the meat and bones of what everyone can actually agree on to move forward with reconciliation. Now, yesterday, Jonathan, we talked about a lot of the divisions within the Democratic Party, especially those scathing words coming from Senator Bernie Sanders and Senator Joe Manchin, really going at each other in the public. And then yesterday, you saw a little bit of that warm embrace. They left the Capitol together. Joe Manchin said, "Get over here, let's take a photo op, arm in arm." I don't know if you want to call it a bromance or frenemies in front of the public, but they said we are talking. So that is happening right now. They are talking, they're not voting, but that meeting of the minds is very important. Once they get to a point where they can actually agree, then it's going to be pen to paper, John. We can actually potentially see some legislation.
I don't know about you, Anne-Marie. I'm not prepared to call that a bromance just yet. When you look at where things are heading, it looks like that package is getting smaller and smaller and smaller. Are you familiar with any numbers that are being thrown around right now? Are we stuck on the numbers still, Anne-Marie? Are we focused on the composition of the package? Where is the focus ultimately at the moment?
I think it's a little bit of both. We know that Senator Joe Manchin had this figure of $1.5 trillion. And in his defense, he says, I came from 0 to 1.5. But the progressives say we came from 6 trillion to 3.5. It's going to be somewhere in the middle. And the signals is something around $2 trillion. There's a question mark regarding where does Kyrsten Sinema, the senator from Arizona, who's also been a bit of a holdout and a hurdle for the Democrats, we don't know exactly where she stands. So we know for some of the policies and top line figure about Senator Joe Manchin, in terms of climate, in terms of how much money he wants to put or caps he wants to put on certain plans. But we don't know where she stands, and that's a really big question mark going into these meetings today.
AMH down in D.C., our Washington correspondent, Anne-Marie Horden. Anne-Marie, I know you've got to run, so run. Thanks for being with us down in Washington. Some news on China from Dow Jones, from the Wall Street Journal. Just to frame this, it's an important story we need to be following here. There's clearly a property slowdown in China, which is clearly going to hurt the economy overall and be a drag, a headwind to economic growth because it makes up so much of GDP in China. Xi Jinping, the Chinese leader, wants to introduce a property tax. It's been talked about in China for a long, long time. And according to sources at Dow Jones, the leader of the Chinese Communist Party is facing some resistance to that China property tax plan. That is a story to keep an eye on. Here's another one, your sector price action with our stocks editor, Dave Wilson. Hey, Dave.
Hey, John. You got 7 of the 11 main industry groups in the S&P 500 higher in early trading. Healthcare stocks leading the way. Johnson & Johnson's earnings out, and they were well received. You're looking at industrial stocks, a little change. The consumer discretionary category as well. Where we're talking retailers, automakers, home builders. In terms of what's down, just 2 groups, the material producers, but consumer staples especially. And I want to take a closer look at that group because you had a couple of disappointing earnings reports. One from Procter & Gamble talking about how their costs for commodities and freight are going to be $2.3 billion higher this fiscal year. And also Philip Morris International. And they're running up against the chip shortage because they not only make cigarettes, but also these heated tobacco products called IQOS. And they can't get enough chips, for those products. So it kind of offsets Walmart, which was higher today after Goldman Sachs raised its earnings or its share price estimate on the company. Nonetheless, I mean, this is a group that peaked at a record in mid-August and is struggling to move higher ever since.
Dave, just quickly after the close, Netflix, is that a big focus for you a little bit later?
Oh, it absolutely is. And the big question is, where does the Squid Game fit in terms of their performance and how does it influence their outlook? Because it started in the third quarter in terms of popularity, but it's really picked up in the last few weeks. So, how is that going to influence the fourth quarter outlook for Netflix? Especially at a time where there's some concern about whether these streaming services can, actually grow at the pace that they have been.
Yeah.
It's shown up, in terms of Walt Disney, some of the analyst calls out there.
Dave, thank you, sir. As always, Dave Wilson, our stocks editor on this equity market. Netflix this year, do you remember the stay-at-home stocks? And then we were going to reopen. You wouldn't want to touch them. In line with the market gains, up 17.3%, just off the gain we've seen in the S&P 500. Want to watch after the close? The team around the closing bell will run you through that one. Coming up, the market moving events you need to be watching. Your trading diary filled with Fed speak. That's next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Is saying it has accelerated innovation in the country and it's planning to appeal the FTC's decision. What's your take on this and how do you plan for further scrutinies?
We are going to see what they make and what changes they are actually bring to this market.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Well, here it is, 5 days of gains on the S&P and back through 4,500. We advanced by about 1/3 of 1%. We're up about 1/10 of 1% on the Russell, on the Nasdaq, up 4/10 of 1%. The equity market is looking okay. If we switch on the board and get to the bond market, we're fading the story that we've experienced over the last week or so at the front end. Yields have been bleeding higher. This morning, they come in about 3 basis points on twos, just a break of 40 basis points, just a small break going into a ton of Fed speak. That's the price action. Here's the trading diary. What you need to be looking for through the rest of this week, and it is filled with Fed speak. Coming up with Richmond Fed President Tom Barkin at noon, followed by President Bostic and Governor Bowman at 1 p.m. Eastern Time. Netflix reporting results after the closing bell. Then we get the Fed Beige Book coming up tomorrow, jobless claims on Thursday, and PMIs following on Friday. And finally, rounding out the week with Fed Chair Jay Powell's policy panel at the back end of this week. That's the one to watch. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
China's growth because it is already slowing. Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, part delays, chip shortages, saddled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look into him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet. So we need a refill of this medication. After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you use the most to send to each other?
There's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings there.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren was